Hello CMA final students. Today I am with you to revise international taxation for CMA final June and December 26 attempts. This marathon will spread across 7 hours. Invest 7 hours of your time. Easily you will be able to score 40 marks in the upcoming exams. Sir, what are the chapters that are going to be covered in this marathon? 3 chapters. Transfer pricing including safe harbor rules. Safe harbor rules are recently notified. Whatever the safe harbor rules are there, they are also clearly discussed in this marathon. So in transfer pricing, methods are discussed, range concept discussed, advance pricing agreement, rollback provisions, secondary adjustment, limitation on interest section 94B, penalties, transactions, specified domestic transactions, audit report, safe harbor rules. So everything is clearly discussed in this marathon. Don't skip. Next, DTAA, non-resident taxation. Some problems are also discussed in transfer pricing around 44, 66, 67, 68 and 70. In non-resident taxation 1 and 2 questions. Don't worry, this is just marathon. Along with this, I am going to do videos on practice revision of various chapters. So transfer pricing practice revision video will also be uploaded in the YouTube. You can be able to watch it. So this is just theoretical marathon with some problems. Okay. So what are you waiting for? Watch this marathon, invest your time for 7 hours. Easily you will be able to score 35 to 40 marks. Let's start right away. So shall we move ahead? Everybody? Yes, let us start. First of all, sir, why transfer pricing we need to study? Why transfer pricing provisions are introduced? I will not take much time. In 2 to 3 minutes, I will explain why transfer pricing came. Okay, what is the necessity to study transfer pricing? Let us take one small example, Nestle. Let's say there are 2 companies, Nestle Inc. USA and there is Nestle Limited. This is an Indian company. In USA, let's say tax rate is 10%. In India, let's say tax rate is 30%. Now, Nestle Inc. holds 80% shareholding in Nestle India Limited. See, once one company holds 80% shareholding in another company, both are related parties now, because if one company holds 80% of the shareholding in another company, entire management will be done by this company only. So here Nestle Inc. USA and Nestle Limited India both are related parties. Now what happened? Nestle Limited purchased goods worth rupees 100 crores. How much worth of goods are purchased? 100 crores worth of goods are purchased, but billed is equal to rupees 150 crores. That means in reality 100 crore worth of goods are purchased, but while passing the entry, while raising the invoice, for how much amount invoice was raised? Invoice was raised for 150 crores. Whenever invoice is raised for 150 crores, normally, ideally, when you prepare P&L account, how much you need to write purchases? 100 crores. But are they writing purchases 100 crores? No. How much they are billing? They are billing it for 150 crores. That means whether purchases increased or purchases decreased, they have increased the purchases. How much purchases were increased by 50 crores? Whenever purchases increases, automatically expenditure increases. Expenditure increases by 50 crores. Whenever expenditure increases, net profit decreases. Correct? See, when expense increases, our profit falls down. So net profit decreases by 50 crores. If net profit falls by 50 crores, how much tax was automatically, tax will also get reduced, right? How much tax gets reduced? In India, tax rate is 30%. 50 crores profit reduced. How much tax will be saved? 50 crore into 30%. 15 crores. Correct? So tax saved, tax decreased is 15 crores. Correct? Okay. This is the story from Nestle Limited India. Now let us see the story of Nestle Inc. USA. Nestle Inc. USA, it will also prepare its P&L account, right? In its P&L account, how much are actual sales? Actual sales are 100 crores. But is it showing actual sales of 100 crores? No. It is showing billed sales. Billed sales of 150 crores. That means here there is increase in sales na. How much is increase in sales? 50 crores. Whenever sales increases, automatically income increases. Income also increases by 50 crores. Net profit also increases. That's what, right? Whenever income increases, net profit also increases. Net profit also increases by 50 crores. Whenever net profit increases by 50 crores, then tax will also increase. But what is the tax rate in USA? Tax rate in USA is 10%. So how much will be the tax increase? 50 crores into 10%, 5 crores. Okay, that means increase in tax of 5 crores, decrease in tax of 15 crores. Overall, what is the net effect? Overall reduction in tax liability. Overall reduction in tax liability. How much? 10 crores. That means globally 10 crores tax is saved. Are you able to understand? So what is happening? Related parties, whenever they are doing cross-border transactions, whenever they are doing international transactions, intentionally they are booking extra expenditure in countries where tax is higher. If tax is higher, intentionally they are raising expenditure. When they raise expenditure, their profits decrease and they will pay lower tax. And conversely, where tax rate is low, there they are booking higher profits. If higher profit is there, lower tax rate is there. Overall, lower tax will be there. So internationally, MNCs, multinational companies which are having businesses across different countries, what they are doing, they are intentionally influencing the price. Okay, they are not showing the correct price, they are showing higher expenditure in country where tax is more, and they are showing lower expenditure in country where tax is less. Are you able to understand? In this way, globally they are not disclosing correct price for transaction, they are influencing the transaction price and thereby they are reducing their overall taxes. Are you able to understand? So but think from Indian government point of view, how much is the expenditure? Expenditure is only 100 crores. But whether 100 crores was booked, 150 crores was booked as expenditure, right? So what Indian government said, whenever you are doing transaction with related party na, at that time, I will not consider actual transaction. Actual transaction, they will not consider. But what they will consider? They will consider like Indian government is going to calculate arm's length price. What do you mean by arm's length price? See, you are selling to your related party. If the same goods are sold to unrelated party, what is the price that you will charge? That will be taken as arm's length price, and accordingly net profit will be calculated. Are you able to understand? So whenever you are buying goods from your related party, obviously price will be influenced, correct? So when you purchase goods from unrelated party, price is not influenced na. So even though you purchase from related party, unrelated party price will be taken and net profit will be calculated. That concept we call as transfer pricing. Whenever you are transferring goods or whenever you are doing transaction with a related party, international transaction, in that case, like actual transaction they will not consider, they will calculate fair transaction, fair price, arm's length price. Are you able to understand? That's how the concept of transfer pricing came into existence. Okay, so in this case they will not consider actual price, what they will consider is arm's length price. Are you able to understand? So in two lines, all multinational companies doing transaction with their related parties, and globally they are reducing their tax liability. To counter such kind of activities, transfer pricing provisions are introduced. Whenever you do transaction internationally with related parties, actual price will not be considered, arm's length price will be calculated, fair price will be calculated, based on fair price net profit will be calculated. Okay, so the concept of calculating fair price and considering it in calculation of net profit we call as transfer pricing. Are you able to understand? Next, when transfer pricing provisions are applicable, there is one section, section 92. When transfer pricing provisions are applicable. See, section 92 is basically charging section. Okay. Section 92 is charging section. Section 92, first of all, there is one section called 92A. In 92A, we are going to discuss about what associated enterprise means. Are you able to understand? See, if you buy goods from unrelated party, transfer pricing provisions are not applicable. If you sell goods to unrelated party, transfer pricing provisions are not applicable, because whenever you are doing transaction with third party, unrelated party, okay, no influence will be there, but only if you do transaction with your related party, then only you will influence the price. So only when you are doing transaction with associated enterprise, then only transfer pricing provisions are applicable. What like whom we call as associated enterprise, that I will discuss with you. Which section explains associated enterprise? Section 92A explains associated enterprise. So like there should be 2 or more associated enterprises. Sir, what do you mean by associated enterprise? I will discuss little later. Okay, just after 3-4 minutes I will discuss what associated enterprise means. Okay, next, section 92B. Section 92. Section 92B says, first of all, transaction should happen in between 2 or more associated enterprises, and such a transaction should be international transaction. Such a transaction should be a international transaction. Such a transaction should be a international. Okay, here what is important is international transaction. Okay, third one, 92C. Then such a transaction value shall be computed at arm's length price. So very simple. First of all, 3 conditions. Only if transaction takes place between 1 or more associated enterprises, then only transfer pricing provisions are applicable. So only if transaction is done with associated enterprise, then only transfer pricing applicable. If transaction is done with unrelated party, transfer pricing is not applicable. Second, whatever the transaction with associated enterprise is there, it should be international transaction. Sir, what do you mean by international transaction? I will explain. Okay, so only in case of international transaction, transfer pricing provisions are applicable. Next, if any international transaction is entered with associated enterprises, then actual transaction value is ignored. In place of actual transaction value, transfer pricing like arm's length price will be calculated. So section 92C speaks about calculation of arm's length price. Section 92B speaks about international transaction. Section 92A speaks about what associated enterprise means. Okay, now let us discuss one by one. First, I will discuss what international transaction means. Next, I will discuss what associated enterprise means. Next, I will discuss how to calculate arm's length price. Okay, first, section 92B, international transaction. When you call a transaction as international transaction, transaction between two or more associated enterprises. Two or more associated enterprises, and at least one should be a non-resident. And at least one should be a non-resident. What do you mean by this? For example, there are two parties, A, B. Now, both A and B are associated enterprises. A is resident in India, B is also resident in India. Now, the transaction between them, can you call it as international transaction? No, you cannot call it as international transaction. Can you call it as international transaction? No. Why? What I said, transaction should take place between two or more related parties. Here related parties means for the time being associated enterprises. Okay, so transaction is happening between associated enterprises, but both associated enterprises are resident in India. If they are resident in India, then can you call it as international transaction? No, you cannot call it as international transaction, because what definition says, to call a transaction as international transaction, transaction should happen between two or more associated enterprises, and out of them one should be non-resident. Then only it will be called as international transaction. Next, A is resident, B is non-resident. Now can you call this as international transaction? Yes, because B is non-resident. Are you able to understand? Transaction is happening between two associated enterprises, A and B, but B is non-resident, so we can call this transaction as international transaction. Next, A is non-resident, B is resident. Now can you call this transaction as international transaction? Yes, because A is non-resident. Next, A is non-resident, B is also non-resident. Now can you call this as international transaction? Yes, transaction is happening between two associated enterprises, A and B, and both are non-residents. Criteria is at least one should be non-resident. In this case, both A and B are non-residents. Are you able to understand? So, like in this case, that transaction is also called as international transaction. So to call a transaction as international transaction, it should happen between two associated enterprises or more than two associated enterprises. Out of them, one should be non-resident. Then only we call such a transaction as international transaction. Is it clear? Sir, till now you are saying transaction. What do you mean by transaction? Transaction can be, that means whatever the transaction between associated enterprises is there, the transaction can be purchase transaction, or the transaction can be sale transaction, or the transaction can be service transaction, or the transaction can be expenditure transaction, or the transaction can be lending. That means one associated enterprise is giving loan to another associated enterprise. That is also transaction. Fair rate of interest should be charged. If lower rate of interest is charged, difference will be treated as income. Okay, borrowing transaction. If any rental income is there, that is also transaction, rental income or expenditure. Even allocation of cost is also treated as transaction. What do you mean by this? Let's say head office will do research and development cost. Whatever R&D cost is there, it is allocated to all branches also. So Nestle head office is located in USA. It has done research and development. Whatever research and development cost is there, that cost is apportioned to subsidiary Nestle India Limited. Even that apportionment of cost should happen at fair transaction, should happen at fair level. For that also we are going to calculate arm's length price. So almost every business transaction, okay, it should happen at fair transaction, it should happen at fair price, okay, that we are going to calculate as arm's length price. So international transaction, transaction between two or more associated enterprises, out of them one should be non-resident in India. And nature of transaction can be either purchase transaction, sale transaction, service transaction, expenditure transaction, lending transaction, borrowing transaction. Even allocation of cost is also treated as transaction. That means in all these cases, that means if all these transactions are done with related parties, if all these transactions are done with associated enterprises, actual price we will not consider. We will calculate arm's length price. Based on arm's length price, we are going to calculate income of the SSC. Are you able to understand? Section 92A, who is called as associated enterprises. Associated enterprise. Let's say there are two companies, A Limited, B Limited. A Limited, if A Limited holds 26% shareholding, either greater than 26% or equal to 26%. If A Limited holds greater than or equal to 26% shareholding in B Limited, then both A Limited and B Limited will be treated as associated enterprises. That means when can we call two companies as related parties? When can we call two companies as associated enterprises? If one company holds either 26% shareholding or more than 26% shareholding in another company, then both companies will be treated as associated enterprises. Now, you will get one doubt. Sir, 26% shareholding, like whether the shareholding should be there for total 365 days? No, even for one day, if there is 26% shareholding sufficient for that year, both the entities will be treated as associated enterprises. A Limited hold 26% shareholding in B Limited on only one day in previous year 24-25, sufficient. Both A Limited and B Limited will be treated as associated enterprises. Are you able to understand? So this 26% shareholding can be at any time during the previous year, at any time during the previous year. So at any time during the previous year, if one entity holds more than or equal to 26% shareholding in another entity, then both entities will be treated as associated enterprises. Are you able to understand? Next, whatever this shareholding is there, this shareholding can be direct shareholding or indirect shareholding. Sir, what do you mean by direct shareholding and what do you mean by indirect shareholding? I'll tell you. A Limited, B Limited, C Limited. A Limited holds 75% shareholding in B Limited. That means A Limited holds more than 26% shareholding, right? So A Limited and B Limited are treated as associated enterprises. Now, B Limited holds 60% shareholding in C Limited. That means B Limited holds more than 26% shareholding. In this case, B Limited and C Limited are associated enterprises. That means indirectly A Limited is holding how much shareholding in C Limited? A Limited holds 60 into 75%, 45% shareholding. A Limited holds 45% shareholding. 45% shareholding means more than 26% shareholding. In this case, A Limited and C Limited, they are also treated as associated enterprises. That means what? A Limited need not have direct shareholding, even though through subsidiaries. Indirectly also, if one company have shareholding in another company, then also both will be treated as associated enterprises. Are you able to understand? So if one company holds either 26% shareholding or more than 26% shareholding in another company, then both companies will be treated as associated enterprises. And that 26% shareholding can be at any point of time during the previous year. Are you able to understand? And the 26% shareholding can be direct shareholding or indirect shareholding. Is it clear? So case 1, case 2. No, case 2 I will explain. Next, case 2. There is Baba Limited. Now, there is Baba Limited, Agni Limited and Vayu Limited. Baba Limited holds more than 26% shareholding in Agni Limited. In this case, Baba Limited and Agni Limited will be treated as associated enterprises. Okay, next, Baba Limited holds more than 26% shareholding in Vayu Limited. In this case, Baba Limited and Vayu Limited are treated as associated enterprises. In this case, Baba Limited holds more than 26% shareholding in Agni Limited and it also holds more than 26% shareholding in Vayu Limited. Now, both Agni Limited and Vayu Limited are also treated as associated enterprises. Are you able to understand? That means if one person holds more than 26% shareholding in two entities, then both of those two entities are also treated as associated enterprises. Are you able to understand? Next, third point, third case. There is AHA Limited and there is OHO Limited. Okay. AHA Limited and OHO Limited. AHA Limited appoints more than half of the board of directors or one executive director of OHO Limited. In this case, AHA Limited and OHO Limited are treated as associated enterprises. That means what? This is management control. Management control. So, if one company controls management of another company, if one company holds, like if one company appoints at least half of the board of directors or one executive director of another company, then both companies will be treated as associated enterprises. Whatever we have seen previously, this 26% shareholding, this is direct control. Sorry, this is capital control. Capital control. What we have seen just now, this is not capital control, that is management control. So if one company controls another company either through capital or through management, then both companies will be treated as associated enterprises. Okay, fourth case. There is A Limited, there is B Limited and there is C Limited. A Limited appoints more than half of the board of directors or one executive director of another company, B Limited. A Limited appoints more than half of the board of directors or one executive director of C Limited. In this case, A Limited and B Limited are treated as associated enterprises. A Limited and C Limited are treated as associated enterprises. In this situation, even B Limited and C Limited are also treated as associated enterprises. Are you able to understand? So did you understand the scenario? In this situation, B Limited and C Limited are also treated as associated enterprises. Case 5. There is Kim Limited. You know Kim Mama, right? And there is a Trump Limited. Kim Limited gives loan to Trump Limited. How much is loan? Loan is 500 crores. Now, how much are total assets of Trump Limited? Total assets of Trump Limited are 800 crores. Now, how much percentage of loan is given as a percentage of total assets? Percentage of loan is equal to 500 crores divided by total assets 800 crores into 100. How much? 62.5%. That means if one entity gives loan to another entity and the amount of loan is like greater than 51%. Okay, here 62.5% means greater than 51%. So if loan given by one company to another company, amount of loan given, percentage of loan given, if percentage of loan given is more than 51% of total assets of another company, then also both companies will be treated as associated enterprises. Are you able to understand? Sixth one. there is Modi Limited and there is also Kim Limited. Now, Kim Limited total borrowings are 700 crores. Modi Limited gave guarantee for 200 crores. That means in this situation, how much worth of borrowings are guaranteed? 200 crore divided by 700 crore into 100. How much percentage of borrowings are guaranteed? 200 by 700 into 100, 28.57%. It is more than 10%. That means if one company gives guarantee for borrowings taken by another company and percentage of guarantee is more than 10%, then also both will be treated as associated enterprises. Are you able to understand here? That means if one company guarantees either greater than or 10% of borrowing, okay, guarantees greater than or equal to 10% of borrowing of another company, then also both will be treated as associated enterprises. Are you able to understand? Seventh case. There is Hero Limited and there is also Honda Limited. You know, once upon a time, Hero used it to manufacture cycles, Hero cycle. Okay. Honda generally manufactures bikes, cars and all. So Hero Limited India, Honda Limited Japan, both got merged, like both formed a joint venture. So now what's happening? Like Hero Limited is Hero Honda Limited. Now Hero Honda Limited is manufacturing bikes. Hero Honda is manufacturing bikes. For manufacturing bikes, whatever the technical know-how is there, entire intangibles are given by Honda Limited, and Hero Limited will manufacture in India bike and it will sell in India. That means here what is happening? Hero Limited entire business depends upon intangibles given by Honda Limited. In this case, Hero Limited and Honda Limited are treated as associated enterprises. That means if one company's entire business is dependent upon intangibles shared by another company, then both these companies will be treated as associated enterprises. Are you able to understand? So that's what. If one company entirely depends upon trademarks, patents, copyrights of another company, then both companies will be treated as associated enterprises. 8. There is Haha Limited and there is Kaka Limited. Now, goods manufactured by Haha Limited are sold to Kaka Limited. So here who is seller? Haha Limited is seller, Kaka Limited is buyer. Generally, who will influence the price? In a transaction, who will influence the price? Seller. Who will decides price? Seller decides price or buyer decides price? You wanted to buy iPhone. Whether seller will tell the price or you will tell the price? Generally, seller will tell the price. Apple will tell one iPhone is 1 lakh rupees. You cannot say please sell Apple iPhone 17 at 50,000 rupees. You cannot say like that. Always it is the seller who will determine the price, who will decide the price. But if buyer influences the price, if buyer decides the price, then something fishy. Okay, buyer should not decide the price, but in any transaction, if buyer is influencing the price, then something fishy, they are doing some unlawful, they are doing some activity which is against, earning profits. So that's why, like, if buyer decides the price, if buyer influences or decides the price, if buyer influences or decides the price, then also, like, both entities will be treated as associated enterprises. Then Haha Limited and Kaka Limited will be treated as associated enterprises. That means what? Very simple. In any transaction, you will read the agreement, right, in between seller and buyer. If buyer determines the price or if buyer influences the price, then both the entities will be treated as associated enterprise. Next. 9. There is Bahu Limited and there is Balla Limited. Now, Bahu Limited manufactures tires. What is major raw material for manufacturing tires? Major raw material is rubber. Correct. Now, 90% of raw material required for Bahu Limited for manufacturing tires is purchased from Balla Limited. Purchased from Balla Limited. In this case, Bahu Limited and Balla Limited are treated as associated enterprises. Are you able to understand? So, if one company buys either 90% of raw material or more than 90% of raw material from another company, in this case, both companies will be treated as associated enterprises. Are you able to understand? There is me, Uma, and there is Uma Limited. Okay. Now, let's say I am having 90% shareholding in Uma Limited. That means I am having more than 26% shareholding in Uma Limited. Correct? That means I am holding more than 26% shareholding. Next, there is my relative. Relative means either, let's say my mother is there. My mother is having 85% shareholding in her company Manga Limited. Manga Limited. Okay, in this case, Uma Limited and Manga Limited are treated as associated enterprises. That means if one individual is having 20% or more than 20%, 26% shareholding in another company, and his relative, he is also having more than 26% shareholding in another company, both companies will be treated as associated enterprises. Here Uma is having more than 26% shareholding in Uma Limited. Manga is also having more than 26% shareholding in Manga Limited. Uma Limited and Manga Limited both are treated as associated enterprises. Are you able to understand? Sir, relative means who? Relative can be either spouse, mother, father, brother, sister, lineal ascendant, lineal descendant. All these will be treated as relatives. And see, sir, only shareholding, only capital control? No. Like Uma can appoint more than half of board of directors or one executive director of Uma Limited. That means here one person should have control in another company. That control can be either capital control or management control. Same, his relative also should have control in another company. Control can be either capital control or management control. Very simple. One individual is having control in one company, his relative is having control in another company. Now both these companies will be treated as associated enterprises. Okay. there is HUF, and there is Rama Limited. HUF holds more than 26% shareholding in Rama Limited. That means what? HUF controls Rama Limited, and that control can be either capital control or management control. That means HUF is holding 26% shareholding in Rama Limited, or HUF appoints more than half of the board of directors or one executive director of Rama Limited. Now, member of HUF is controls Bhima Limited. In this case, Rama Limited and Bhima Limited both are treated as associated enterprises. Are you able to understand? That means if HUF controls one company and relative of HUF controls another company, both companies will be treated as associated enterprises. Are you able to understand? Last case, 12th case. Let's say there is a person. That person holds greater than or equal to 10% of profit sharing ratio, either in partnership form or LLP or AOP, BOI, AJP. Then both will be treated as associated enterprises. That means what? Let's say I had 30% share in a partnership firm. I and partnership firm both will be treated as associated enterprises. So if a person holds either 10% of profit share or more than 10% of profit share in another entity, that can be either partnership firm, LLP, AOP, BY, then that person and that entity both will be treated as associated enterprises. Are you able to understand? So these are 12 different cases of associated enterprises. Are you able to understand? So we have discussed what international transaction means. We have discussed what associated enterprise means. Next, we are going to discuss what arm's length price, how to calculate arm's length price. Section 92C. Computation of arm's length price. So there are 5 methods to calculate arm's length price. First, comparable uncontrolled price method. In short, we call this as cup method. Okay. Second one is resale price method. In short, we will call this as RPM, resale price method. Third, cost plus method. In short, we will call this as CPM. Fourth, profit split method. In short, we call this as PSM. Last one is transactional net margin method. Transactional net margin method. In short, we call this as TNMM method. So there are 4 methods to calculate arm's length. First, very important, comparable uncontrolled price method. Many times this method is asked in the examination. Next, I am going to explain how to calculate arm's length price under CUP method, comparable uncontrolled price method. I will take one example. Through that example, I am going to explain. There is A Limited, there is B Limited, and there is C Limited. A Limited holds 60% shareholding in B Limited. So can we call A Limited and B Limited as associated enterprises? Yes, because A Limited is holding 60% shareholding, which is more than 26% shareholding in B Limited. Both are treated as associated enterprises. However, C Limited is unrelated party. Unrelated. Next. A Limited sold 10,000 units to B Limited for rupees 2,000. Same A Limited sold 4,000 units to C Limited for rupees 3,700. Tell me one thing, for related party, for associated enterprise, goods are sold only for 2,000 rupees. For unrelated party, goods are sold for 3,700. That means intentionally they are sold at lower price. Why they are selling at lower price? Because if sales price reduces, sold for 2,000 rupees only for related party. If they sell for 3,000, sales increase, profits also increase. To reduce profits, they sold at lower price of 2,000 rupees. Are you able to understand? That means what? With related party, goods are sold at lower price. With unrelated party, goods are sold at higher price. So the main agenda, the main intention is reducing sales, reducing profits, and thereby reducing tax liability. So like here, comparable uncontrolled price method means just like how you are billing to unrelated party, in the same way you have to bill for related party also. So let's say I am selling goods to my father, I am also selling goods to third party. Whatever the price I take from third party, same price I also have to take from my father. Okay, so whatever the actual price that is there between me and my father, that will be ignored, and third party, with the third party, whatever the price I charged, that will be taken as arm's length price. Are you able to understand? So comparable uncontrolled price method means like whenever you are doing transaction with related party transaction will be ignored, and unrelated party with comparable uncontrolled transaction. See, when you do transaction with third party, it is uncontrolled transaction only. So whatever the transaction with third party is there, whatever the uncontrolled transaction is there, we will take uncontrolled transaction and we will compare actual transaction and uncontrolled transaction. Thereby we are going to calculate arm's length price. Here actual transaction is 2,000 rupees, correct? But comparable transaction is 3,700. So we will compare these two and we are going to calculate arm's length price. Are you able to understand? Now, you cannot say, sir, here arm's length price is 3,700 rupees. You cannot say straight away like that, because there can be some functional differences. See, here 10,000 units are sold, here only 4,000 units are sold. Whenever you sell goods, lump sum goods in quantity, you will give more discount, correct? So you cannot compare 10,000 units with 4,000 units, okay? Because whenever more goods are sold, more discount will be given. See, you are comparing two cars. You can't compare Bellona with Innova Krista. Bellona is 5-seater, Innova Krista is 7-seater. How can you compare 5-seater car with 7-seater car? Not possible, right? In the same way, here also, for related party you sold 10,000 units, for unrelated party you sold only 4,000 units. So you cannot compare 10,000 units with 4,000 units. Now, the point is, here, if 10,000 units are sold to unrelated party, sold to C Limited, then how much will be the discount? Additional discount is 400. Additional discount is 400. Are you able to understand? That means what? For unrelated party also, if A Limited sells 10,000 units, how much discount A Limited would have given? A Limited would have given 400 rupees discount. So that is functional difference. We need to adjust functional difference and we need to calculate arm's length price. Second functional difference. Second functional difference can be freight on board or CIF. See, there are two terms, FOB, CIF. Freight on board, CIF. Freight on board means what? Goods are brought only to the port. Let's say I am buying goods from USA. Goods will not be delivered in my location. Goods will be brought to USA port. Are you able to understand? So, goods till seller's port. If goods are brought till seller's port, then we call it as freight on board. If goods are brought to buyer's port, see, let's say I am importing goods from USA. I paid 1 lakh rupees. For that 1 lakh rupees, goods are shipped and they are transported to Mumbai airport. So that means what? Whatever the air charges or whatever the water transportation charges, insurance and freight both are borne by that seller only. Then we call it as CIF. Okay, insurance and freight will be borne by seller. But in case of FOB, seller will not bear insurance and freight. Seller will bring goods till his port. From there onwards, we need to transport the goods. We need to pay insurance and freight. Are you able to understand? So freight on board means what? Till seller's port. CIF means what? Till buyer's port. Are you able to understand? In case of freight on board, transportation charges, freight and insurance are required to be paid by buyer only. However, if in case of CIF, freight and insurance will be paid by the seller. Are you able to understand? For example, for related party, goods are sold on freight on board. How much? Hold on. For unrelated party, goods are sold on freight on board. And for related party, goods are sold on CIF basis. Freight on board means what? He will not bring goods to our country. In his country's port only, goods will be delivered. Okay, from there onwards, we need to pay insurance and freight. For unrelated party also, if goods are sold at CIF, additional charges will be 250 rupees. That means what? In case of related party, goods are sold on freight on board basis. In case of unrelated party, see, for example, C Limited is unrelated party. Let's say he is located in Germany. Till Germany port, goods will be sent by us. Whatever the water transportation charges, insurance and freight, they will be borne by us only. Are you able to understand? So that is the difference between FOB and CIF. Now the point is, tell me in this whole transaction, what is the uninfluenced price? 2000 rupees is influenced price, right? Because whenever I do transaction with related party, obviously that price is influenced price. So whatever this 2000 is there, that is influenced price, and whatever this 3000 is there, that 3000 is uninfluenced price, correct? So when you are calculating arm's length price, what you need to take as base is, you will take uninfluenced price as base. How much is uninfluenced price? Uninfluenced price is 3700, correct? And this uninfluenced price is for 4000 units. If 10,000 units are sold, how much additional discount was given? Additional discount of 400 will be given, correct? So what is uninfluenced price for 10,000 units? If 10,000 units are sold, discount will be given. How much is the discount? Discount is 400, correct? Then 3300. This 3300 is uninfluenced price, but at 10,000 units, correct? 10,000 units. So we need to compare both the transactions. To compare both the transactions, they should be brought into ideal terms. Okay, unrelated party 4000 units, related party 10,000 units. For unrelated party also, if goods are sold at 10,000 units, then you can compare both of them na. So that's why even though for unrelated party 4000 units are sold, if 10,000 units are sold, how much is the uninfluenced price? We need to do the functional adjustment. Here reduction of discount we call as functional difference. Are you able to understand? Next, second functional difference is there. This uninfluenced price is at freight on board. See, for related party, we are selling at CIF basis, cost, insurance and freight. For unrelated party, we are selling goods at freight on board. For unrelated party also, if goods are sold at CIF basis, how much extra we charge? Additional charges 250 rupees. That we need to adjust, add additional charges. additional charges 250 rupees. So then we are going to arrive at uninfluenced price at CIF level. How much? 3,550. Correct. So now did you understand? When you are comparing both the transactions, if there are any functional differences, you have to give adjustment for functional differences. Okay, obviously for unrelated party, same quantity we will not sell. So for related party, how many goods are selling? Same goods, if they are sold to unrelated party, how much will be the discount that we will adjust? Okay, like that. If there are any functional differences, warranty, for related party warranty is given, for unrelated party warranty is not given, for unrelated party also if warranty is given, how much then price will increase, how much is the increase in price, those kind of functional differences we need to do. After doing functional differences, we are going to arrive at arm's length price. So here arm's length price is 3,550. But what is the actual sale price? Actual sale price for related party, they are sold for 2,000. Actual sale price is 2,000. Correct. Now how much is the difference? Difference is 1,550. This will be added to income of the SSC. Income of. Are you able to understand? Very simple. So in case of comparable uncontrolled price method, uninfluenced price, with unrelated party, whatever the price is there, take that price, do functional adjustments. Okay, after doing functional adjustments, you are going to arrive at arm's length price. Compare arm's length price with actual price, you are going to arrive at income that is required to be added. Are you able to understand? Now let's do one problem in institute workbook. See, this is institute workbook. You can download from the website. Open illustration 5. In class, I have discussed one point. There is a company and there is a person in notified jurisdictional area. Notified jurisdictional. Whenever a transaction is done with a person in notified jurisdictional area, then both will be treated as associated enterprises. See, there is one country called Cyprus. That country used to not support India. Whenever Indian government asks Cyprus, give some information, Cyprus will not give information. So what Indian government did, Indian government declared Cyprus as notified jurisdictional area. So any person in India, if they do transaction with a person in Cyprus, then every transaction will be treated as international transaction and both entities will be treated as associated enterprises. That means whenever you do transaction with a person located in notified jurisdictional area, both will be treated as associated enterprises. Are you able to understand? This concept I explained in class also, if you remember. Whenever you do transaction with a person located in notified jurisdictional area, both will be treated as associated enterprises. Now let us see further. Xenon India Limited, an Indian company, sold goods on 15 January 25 to M Corp, a company located in notified jurisdictional area, for 9.8 crores on FOB basis. So there are two companies. Xenon India Limited and there is another one, M Corp. It is located in notified jurisdictional area. It is located in India. Both will be treated as associated enterprises, right? Because whenever transaction is done with a person located in notified jurisdictional area, both will be treated as associated enterprises. Now sold goods, how much is sale value? Sold goods for 9.8 crores. And how goods are sold? Goods are sold on FOB basis, freight on board basis. During same financial year, identical goods were sold on CAF basis to unrelated customers in Germany for 10.7 crores. So what Xenon India Limited doing? Xenon India Limited sold goods to unrelated party. For rupees 10.7 crores. Unrelated party. Goods are sold for 10.7 crores. And that happened on CAF basis. Ocean freight and insurance of 18 lakhs, and the company also provides after sales support to 12 lakhs to customer. See, functional difference 1. How much is freight and insurance? Freight and insurance is 18 lakhs. Next. Here freight on board, here CAF basis. Because of CAF basis, price will be increased. Of course, whenever you pay insurance and freight, automatically sale price will increase. So how much? The difference is 18 lakhs. Next. Second functional difference. Whenever goods are sold to unrelated party, no sales support. But whenever goods are sold to related party, there is a sales support. There is sales support. Okay. Now, how much is that support cost? Support cost is 12 lakhs. This is functional difference 2. Functional difference 1 is FOB and CAF. Functional difference 2 is sales support. Now tell me, in this entire transaction, whether 9.8 crores is influenced or 10.7 crores is influenced. 9.8 crores is influenced. 10.7 crore is uninfluenced, correct? You have to take uninfluenced price. How much is uninfluenced price? Uninfluenced price is 10.7 crores. Okay. And this uninfluenced price is at CAF level and no warranty, correct? Sorry. CAF level and sales support also. CAF level and sales support. Tell me one thing. Whenever you do transaction with related party, did you give sales support? You did not give sales support. If sales support is not given, obviously that sales support cost is reduced. Whenever sales support cost reduces, selling price also reduces, right? So we need to reduce sales support cost. Sales support cost. How much is sales support cost? Sales support cost is 12 lakhs. So if we reduce 12 lakhs, how much? $10.58 crores. Okay. That means 10.58 crores is uninfluenced price with no sales support, but at CAF basis. That means what? If there is sales support, price is 10.7 crores. If there is no sales support, then price is 10.58 crores. That's what now. If I have to give after sales support, I will increase the price. If I am not required to give after sales support, I will not, instead I will decrease the price. That's why here the price is decreased. Next. Here goods are on CAF basis, but for related party, are you selling goods on CAF basis? No. For related party, you are selling goods on freight on board basis. If for unrelated party also, goods are sold on freight on board basis, then insurance and freight will be borne by unrelated party only, correct? So that insurance and freight also we need to reduce, less insurance and freight. How much is insurance and freight? Cost of insurance and freight 18 lakhs. 18. So then 10.4 crores. This is uninfluenced price. Uninfluenced price with no sales support and on FOB basis. See, for related party, you are selling goods on FOB basis and you are not giving sales support, no sales support. For unrelated party also, if there is no sales support and if goods are sold on freight on board basis, then uninfluenced price will be 10.4 crores. Are you able to understand? So, how much is the arm's length price here? Therefore, arm's length price is equal to 10.4 crores. But how much is actual sale price? Actual sale price is 9.8 crores. 9.8 crores. So how much is the difference? 0.6 crores. 0.6 crores will be added to income of the SSC. That means he should ideally, with no sales support and with no warranty, he should, like, with no warranty and freight on board basis, he should have sold goods for 10.4 crores. But is he selling for 10.5 crores? No, he is selling at 9.8 crores. Intentionally, he is reducing the sales. How much sales he reduced? 0.6 crores. That will be added to income of SSC. Are you able to understand? Now I hope you understood CPM, cost plus. Okay, remaining methods we are going to see in part 2. Okay, thank you. Second method for calculation of arm's length price is resale price method. When resale price method is applicable, whenever you buy goods from your associated enterprise and resell in India. In such a case, resale price method is applicable for calculation of arm's length price. Let's say there is one company XYZ Limited. XYZ Limited is buying goods from its associated enterprise. Whatever the goods bought from associated enterprise are there, they are resold in India. Resold in India. So in this case, we are going to calculate arm's length price using resale price method. See, if XYZ Limited buys goods from unrelated party. Okay, if it buys goods from unrelated party and resells in India, then how much is the GP margin? We will take that GP margin. That means from unrelated party, if goods are bought and resold in India, how much is the GP margin of XYZ Limited? We will take unrelated party transactions GP margin and thereby we are going to calculate arm's length price using resale price method. Are you able to understand? So very simple. Whenever one entity, one company buys goods from unrelated party and resells in India, then for calculation of arm's length price, we are going to use resale price method. Are you able to understand? In unrelated party transaction, whatever the GP margin is there, using that GP margin, we are going to calculate arm's length price. Exactly how to calculate arm's length price, you will understand if we do one problem. Let us do one problem so that you will get better clarity. So you can see this problem in institute material. Illustration 2 in institute workbook actually, not material. Cool Air Private Limited is associated enterprise of Chill Corp Inc. USA. So there are two companies. Cool Air Private Limited, Chill Corp Inc. This is based in USA and this is based in India. In question itself, it was said both are associated enterprises. So Cool Air Private Limited and Chill Corp Inc. both are treated as associated enterprises. During previous year 24-25, Cool Air imported 4,000 AC compressors from Chill Corp at 8,200 per unit and sold them to Chill Zone Limited at 12,000 per unit. So what happened? Goods bought. How many goods are bought? 4,000 units at the rate of rupees 8,200 per unit. Next, what happened? Whatever the goods bought are there, they are resold in India. At what price they are resold in India? For rupees 12,000 per unit. Okay, this is the information. To whom they are resold? Chill Zone Limited. They are resold to another company, Chill Zone Limited. Cool Air also had purchased similar compressors from unrelated party Frostech Limited Germany and resold them at same resale price of 12,000 with a GP margin of 25%. So there is another company, Frostech Limited. Frostech Limited. This is basically a German company and it's unrelated party. Unrelated party. So from unrelated party also goods are purchased and are resold in India. At what price they are resold? Resold in India for rupees 12,000 per unit. How much is GP margin? GP margin is 25%. Okay, they are resold with a GP margin of 25%. So this is the information. Next. However, Chilcorp provided a special volume discount of 1800 per unit, whereas Frostech provided only 700 per unit discount. So, how much is the discount given by functional difference 1? How much is the discount given by related party? Related party gave discount of 1800. Unrelated party gave discount of how much? 700. Additionally, Chilcorp delivered at port without insurance. See, goods are delivered without freight and insurance. That means freight on board basis. On freight on board basis, how much is the cost? Cost is 1400 per unit. So shipping charges. Second functional difference, shipping charges 1400. This is based on freight on board. Here how much are shipping charges? See. In case of Frostech, delivery was at factory, Cool Air paid only 500 per unit on shipping. So how much are shipping charges? 500. And this is based on CIF basis. So one is based on FOB, another is based on CIF. On FOB, freight charges are 1400. On CIF, freight charges are 500. Okay. So here what we will do? Whenever goods are bought from unrelated party and are resold in India, how much is his GP margin? His GP margin is 25%. So from related party also, if he buy and resell in India, minimum he should get 25% GP margin. After his GP margin, additional amount he can pay to related party also. But there are functional differences now, discount and shipping charges. We will adjust functional differences and we are going to calculate arm's length price. Okay, now let's do one thing. Let's prepare one P&L account. You will understand easily. How much is sale price? 12,000 rupees. From unrelated party, if goods are purchased and are resold in India, generally how much is GP margin? GP margin is 25%. So from related party also, if he is buying and reselling in India, minimum he should get 25% GP margin. How much 25% means? 3,000 rupees. 12,000 into 25%, 3,000 rupees. See, related party is giving discount of 1800. Unrelated party is giving just 700 rupees discount. So whenever goods are purchased from unrelated party, you will get lower discount, right? When you get lower discount, your price increases. That's what. For example, let's say I went to Bata showroom to buy chappals or to buy shoes. Let's say price is 4000 rupees. Discount is 300. When discount is 300, my price is 3700. If discount increases, if discount is 800, okay, then price will be 3200. So whenever discount increases, price decreases. So here, whenever you are buying goods from related party, discount is higher, 1800 rupees. But whenever you buy goods from unrelated party, discount is only 700. See, whenever discount decreases, price will increase. See, 800 discount, price 3200. 300 discount, price 3700. So whenever discount decreases, price increases. Am I correct or not? So when you buy goods from related party, as he is related party, he is giving 1800 discount. Why will unrelated party give 1800 discount? Unrelated party is giving only 700 rupees discount. So whenever you buy goods from unrelated party, your price will increase because lower discount was given. So how much is increase in cost? Increase in cost because of lower discount. Lower discount. How much is increase in cost? Related party giving 1800 discount, unrelated party 700 only. So 1800 minus 700, 1100 is increase in cost. That is functional difference 1. Okay. Functional difference 2. When you buy goods from related party, shipping charges are 1400 because FOB basis. When you buy goods from unrelated party, shipping charges are 500 because CIF basis. Correct? So from unrelated party, the basis is CIF. From related party, the basis is FOB. From unrelated party also, if goods are bought on freight on board, if goods are bought on freight on board basis, how much will be the cost? Cost will be 1400 rupees. That means, see, we need to compare both the transactions. From related party, it is at FOB basis. From unrelated party, it is at CIF basis. If we convert it into FOB basis, that means what? Even from unrelated party also, if we buy goods on FOB basis, how much will be the cost? Cost is 1400. Correct. So how much will be increase in cost if we buy goods from unrelated party on FOB basis? Increase in cost. Increase in freight cost. See, related party CAF basis. Sorry. Related party FOB basis. Unrelated party CAF basis. From unrelated party also, if goods are bought on FOB basis, then cost will be 1400, right? How much will be the increase in cost? Increase in cost is equal to 1400 minus 500. 900. So how much is the maximum amount that can be paid? Maximum amount that can be paid for buying goods from related party, for buying goods, that is nothing but balancing figure. How much is balancing figure? Calculate. 12,000 minus 3,000 minus 1100 minus 900. Arm's length price is 7,000. This 7,000 will be treated as so arm's length price is 7,000 rupees. How much is actual purchase price? Actually, they are bought for 8,200 per unit. Actual purchase price. See, it is sufficient if 7,000 is paid. But how much is actually paid? 8,200 rupees. So how much is extra expense? Extra expense is 1,200 rupees per unit. How many units are purchased? 4,000 units. So how much is total extra expenditure? 4,000 into 1,200, 48 lakhs. So whatever 48 lakhs is there, that will be added to income of S. Okay. I hope you got clarity now. 48 lakhs will be added to income. So very simple, students. When goods are bought from associated enterprise and are resold in India, then for calculating arm's length price, we use resale price method. How will we calculate? We will take resale amount. From that, we will reduce GP margin in unrelated transactions. How much is our GP margin in unrelated transactions? That will be reduced. Then functional differences we will adjust. After adjusting functional differences, we are going to calculate that arm's length price will be compared with actual price. Accordingly, we are going to calculate the. Another important point I wanted to tell you. This is very interesting. Due to arm's length price, okay, if your income increases or if your loss decreases, then only transfer pricing provisions are applicable. If due to arm's length price, if your income decreases or loss increases, then transfer pricing provisions are not applicable. That means transfer pricing provisions are entirely in favor of income tax department. So, like because of arm's length price, your income increased, transfer pricing provisions are applicable. Because of arm's length price, your loss decreased, transfer pricing provisions are applicable. But because of arm's length price, if there is decrease in your income or increase in your loss, okay, then it is adverse to department. In such a case, transfer pricing provisions are not applicable. Yeah, Preetham doubt is what if both the transactions are on FOB basis? If both the transactions are on FOB basis, there is no functional difference at all. You need not do any adjustment. When will you do adjustment? If one transaction is at FOB basis, another transaction is at CF basis, then you will bring both at one level. Okay, then you have to do the adjustment. Otherwise, adjustment is not required. I hope you understood this. So did you understand this? Because of arm's length price, increase in income, decrease in losses, transfer pricing provisions are applicable. Otherwise, transfer pricing provisions are not applicable. Next, we will discuss cost plus method. When cost plus method is applicable, whenever you are providing services to your associated enterprise, then you are going to calculate arm's length price using cost plus method. Okay. See, if comparable uncontrolled transaction is available, then CUP method you will follow. If comparable uncontrolled transaction is not available, then you will follow cost plus method. That means how much cost you incurred in providing goods or providing services to your associated enterprise. You will take that cost and you will take normal GP margin in other transactions. By adding that GP margin, you are going to calculate arm's length price. So when cost plus method is used, whenever you are buying, like whenever you are providing goods or providing services to your associated enterprise, then you are going to use cost plus method. What you will do, you will calculate direct cost. You will calculate indirect cost for providing that goods or services. After adding both of them, you will arrive at total cost. To that total cost, you will add GP margin. By adding GP margin, you are going to arrive at arm's length price. Okay. So did you understand? Now we will do one problem. You will get better clarity. Open illustration 1. Galaxy Inc. USA holds 40% equity in Comet Limited, India. So there are two companies, Galaxy Inc. USA and there is Comet Limited, India. In question itself, it was said Galaxy Inc. holds 40% shareholding. 40% shareholding means more than 26% shareholding, right? So both will be treated as associated enterprises. Okay. During 24-25, Comet Limited rendered 2,500 man hours for Galaxy Inc., charging 1,200 per man hour. So, Comet Limited provided services. How many man hours? 2,500 man hours. What is the billing? Billed at 1,200 per man hour. Okay. Total cost of providing these services amounted to 22 lakhs. So how much is cost? Cost is equal to 22 lakhs. Billing, sales is done at 1,200 rupees per man hour for 2,500 man hours. Okay. Similar services were rendered to unrelated enterprise Star Limited India with a GP margin of 55%. That means what? In unrelated party transactions, how much is the GP margin? GP margin is 55%. Additional information. Galaxy Inc. provides cloud infrastructure support valued at 10% of GP margin. That means what? Here, Galaxy Inc. provides infrastructure support. Because of that, cost decreases by 10%. Cost decreases by 10%. Tell me one thing, if same services are provided to unrelated party, whether unrelated party gives you infrastructure support, unrelated party will not give infrastructure support. You have to buy the infrastructure. Whenever you buy the infrastructure, your cost increases. Whenever your cost increases, your GP margin decreases. So we need to calculate arm's length GP margin. Okay, shall we calculate arm's length GP margin? Arm's length GP margin. So how much is GP margin in unrelated party transactions? GP margin is, second tell me, 55%, correct? Now, related party is giving infrastructure support, whether unrelated party gives infrastructure support? No. So, when you are dealing with unrelated party, then no infrastructure support. If infrastructure support is not received, then your cost increases. Whenever your cost increases, your GP margin decreases. So for finding arm's length GP margin, that means if the same transaction, if we do with unrelated party, okay, how much is the gross profit margin that we get? That gross profit margin is arm's length GP margin. When you are calculating arm's length GP margin, whatever the reduction, okay, because of increase in cost, whenever you do transaction with unrelated party, your infrastructure cost increases, automatically gross profit decreases. Whatever the impact on gross profit is there, that we need to give. Okay, so our GP will decrease. How much is decrease in GP? Because of infrastructure cost. How much? 10%, right? 10% of GP. How much is 10%? 55 into 10%, 5.5%, correct? Next. Galaxy Inc. is given a 60-day credit period. Cost of this extended credit is 2% of the billing rate and it is not given to unrelated parties. So what do you mean by this? Galaxy Inc. is related party, right? For related party, 60 days credit period was given. Okay. For unrelated parties, will Comet Limited give credit period? For unrelated party, no credit period. No credit period. That means what? For related party, 60 days credit period is given. For unrelated party, no credit period was given. Whenever credit period is given, interest cost will be there. Interest cost will be there. Interest cost increases. Whenever interest cost increases, gross profit margin decreases. But whenever you do transaction with unrelated party, you are not giving credit. Immediately you are getting money. Are you giving credit? You are not giving credit. If you are not giving credit, there is no interest cost for you. So interest cost decreases. Whenever interest cost decreases, GP margin increases. Are you able to understand? Interest cost decreases and GP margin increases. So how much is the increase in GP margin? Add increase in GP for not giving credit period. For not giving credit period. How much is given here? 2%. 2%. 55 into 2%. How much? Calculate. 1.1%. So how much is arm's length price? 50.6%. Okay. I think it's correct. Yeah. So arm's length GP margin. Arm's length GP margin is 50.6%. Okay. So we will take total cost. How much is total cost? It was given 22 lakhs, right? Total cost is 22 lakhs. For 22 lakhs, we need to add GP margin. Add GP margin at the rate of 50.6%. How much? 11 lakh. Hold on. Generally, GP margin, what is the formula? Formula for GP margin, gross profit divided by sales into 100, correct? So, if sales are 100, GP margin is 50.6%. How much is cost? 100 minus 50.6. Cost is 49.4, correct? So 49.4 plus 50.6, exactly it will be 100%. So shall we calculate GP margin doing cross calculation? Just give me 1 second. So now tell me how much is GP margin? 22 lakhs divided by 49.4 into 50.6. How much? 22 lakh 53,441. In that case, sales will be 22 lakhs plus 22 53 441. 44 lakh 53,441. That will be considered. So how much is arm's length price? Arm's length sales. Arm's length sales are 44 lakh 53,441. How much are actual sales? Actual sales. You can calculate 2,500 man hours into 1200 per man hour. 2,500 into 1200. Much? 30 lakhs. See, Here underbilling was done. If you do underbilling, your sales will decrease. Automatically your profit will decrease. That's why underbilling was done. So how much is underbilling, under sales here? Under sales are 14,53,441. Whatever the under sales are there, that will be added to sum of. Now did you understand how we do under cost plus method? For related party, how much is our direct cost, how much is our indirect cost? You will go to unrelated party and check how much is GP margin charged by unrelated party. Whatever the GP margin charged by unrelated parties is there, that will be considered in calculation of. I hope you understood. Shall we go to the next method, profit split method? This method will be interesting. How to profit split. Sir, when profit split method is used for calculating arm's length price, generally, whenever two or more companies internationally come together and do business, whenever two or more companies enter into joint venture internationally and do transactions, then we will calculate combined profit. Whatever the combined profit is there, such combined profit will be divided among the entities, among the parties of the joint venture on the basis of contribution. That means how much effort is given by each entity. Based on that effort, we are going to divide the profit. Original profit sharing ratio, that is not relevant. What is relevant for us is how much effort was made, contribution was made. Based on contribution ratio, we are going to divide the combined profit and we are going to calculate arm's length price. Are you able to understand? For example, you know about Honda Limited, right? Honda Limited is basically Japanese company. And there is Hero Limited. This is basically Indian company. Both entered into joint venture Hero Honda Limited. Okay. Now what they are doing, joint venture is Hero Honda. Now Honda Limited will give intangibles. Okay. Hero Limited will do manufacture. And then they sell bike in India. So here Honda from Japan, Hero from India, both are entering into joint venture internationally. Honda is giving intangibles, Hero is doing manufacture of bike and they are selling bike in India. Now on sale of bikes, we are going to calculate combined profit. Whatever the combined profit is there, that is to be apportioned between Honda Limited and Hero Limited based on effort kept by each entity. Okay, whatever the profit sharing ratio between Hero Limited and Honda Limited, that is not relevant for us. What is relevant for us is contribution. How much contribution is done by Hero Limited, how much contribution is done by Honda Limited. Based on that contribution, we are going to divide combined profit and we are going to calculate arm's length price. Are you able to understand? Now, let's do one problem. We will automatically get clarity about calculation of arm's length price in case of profit split method. Shall we do? Yes. Intech Limited, an Indian company, designs and develops proprietary solar powered drone. Its Singapore subsidiary, Skytech Pte Limited, develops advanced navigation software that integrates with the drone. So there are two companies. Inditech Limited, Skytech Pte Limited. Intech Limited is basically Indian company. Skytech Pte Limited is Singapore company. and it's Singapore subsidiary. So in question itself said it is subsidiary. Subsidiary means more than 50% shareholding. The moment it is more than 50% shareholding, both are treated as associated enterprises. Correct? Next. Preetham, listen, you will understand this concept superbly. Okay. So what Intech Limited will do? Intech will develop drone. That means basically Intech Limited will manufacture a drone. Manufacture drone. For this drone, navigation software that will be given by Singapore company. Navigation software that will be given by Singapore company. Intech manufactures and supplies the drone hardware to Skytech. Skytech integrates the software and sells final product to unrelated customers. So what Skytech Limited will do, after adding software, finished drone will come. That finished drone will be sold. That finished drone will be sold. Sold by Skytech. This is the scenario. Due to uniqueness of technology, no direct comparables exist. Traditional methods like CUP, TNMM are not reliably applicable. However, comparable market return for routine manufacturers without intangibles is 12% on manufacturing costs. That means what? Very simple. For example, both did not enter into joint venture. For example, it will manufacture drone only. It will manufacture drone and it will sell only hardware in India. If hardware in India is sold, how much is GP margin? The gross profit is equal to 12% of cost. Okay. Similarly, Skytech PTE Limited also. It will not manufacture a drone. It will sell only navigation software. Okay. On that sale, how much is GP margin? GP margin is equal to 12% of cost. That means without assembling, without combining, if each part is sold independently, okay, if hardware is sold independently, if software is sold independently, how much is the GP margin? GP margin is 12% on cost. Okay, that means individual level, if each one is sold independently, independent GP margin is 12% of cost. Next, other data was given, available financial data. Sales to third party, that means drone is sold for 3000 rupees. How much is manufacturing cost? 400. And manufacturing cost of hardware is 400. Manufacturing cost of software is 500. Next, development cost means what? Research and development. Okay, that means initially for developing hardware it costed 150 rupees. For developing software it costed 100 rupees. Okay. Next, operating cost. Operating cost means nothing but admin expense. Admin expenses are 100, 200. So overall total cost is 1450. Combined profit is 1550 rupees. Okay. Now we will take combined profit. From combined profit, we are going to apportion that combined profit based on contribution. Okay. But here there is one small explanation. Listen for next 2-3 minutes. You will understand. Okay. Now tell me, how much is combined profit? Combined profit 1550 rupees. Now from combined profit, individual profits are to be reduced. Only balance combined profit is to be apportioned. Are you able to understand? How much is individual combined individual profit? Individual profit of Inditech Limited. How much? Individual profit of Intech Limited is 12% of cost. How much is cost of drone? 400, right? 400. So 400 into 12%. 48. That will be reduced. Next, individual profit of Skytech Pte Limited. How much? It is also 12% of cost. How much is cost? 500, correct? 500 into 12%, how much? 60 rupees. So how much is balance combined profit? Balance combined profit. 1442. That means what? See, everyone can do their own business. Honda can do its own business. Hero can do its own business. Honda can sell only intangibles. Hero can sell only hardware. Here also, Inditech Limited can only sell hardware. Okay. Skytech Pte Limited can only sell software. On sale of hardware, GP margin is 12% of cost. On sale of software also, GP margin is 12% of cost. So whatever the individual GP margin is there, that individual GP margins are to be reduced. Whatever the balance combined profit is there, this balance combined profit is to be apportioned between Inditech Limited and Skytech Limited, or Skytech Pte Limited, based on contribution ratio. Okay, based on contribution ratio. That means to develop that drone, how much is the effort kept by Inditech Limited? How much is the effort kept by Skytech Pte Limited? See, generally effort means what? Research and development. How much research and development was done by? How much R&D was done by Inditech? Inditech has done R&D of 150, correct? Skytech has done R&D of 100. So how much is the development? R&D effort kept is 150 is to 100, correct? So here contribution ratio is 150 is to 100. Based on that contribution ratio, we are going to apportion the combined profit. So 1442 into 150 divided by 250. How much? 865.2. Here 1442 into 100 by 250. How much? 576.8. See, two levels of profit. First level of profit is at individual level. If they are sold independently, how much is the profit? Second level of profit is combined profit. That combined profit is apportioned based on contribution ratio. Okay. Now, we are going to calculate arm's length price. Shall we calculate arm's length price? Now, tell me how much is variable cost? See, whatever the development cost is there, development cost is not variable cost, correct? But that will be apportioned on each product, that amount will be apportioned. So how much is total cost for Inditech Limited? Total cost is 650 rupees. Total cost. Total cost of hardware 650 rupees. If that hardware is sold independently in India, how much is the GP margin earned? If it is sold independently, GP margin earned is 48 rupees, correct? So add GP on sale in India. How much? 48 rupees, correct? GP on sale in India, 48 rupees. And how much is combined profit, apportioned combined profit? Apportioned combined profit is 865.2. Now how much is arm's length price? 650 plus 48 plus 865.2, 1563. Okay, that will be considered as arm. Now did you understand profit split method? Very simple. Cost. For total cost, you will add two profits. individual profit and apportioned combined profit. After adding two profits, you are going to arrive at arm's length. I hope Preetham, now you are very clear. Next, last, we are going to discuss TNMM method, transactional margin. In class, you had some issues with me, but I hope with this profit split method is very clear for you. Next, transactional net margin method. See, cost plus method, transactional net margin method, more or less they will appear very similar. But the difference is, in cost plus method, we will take GP margin. In TNMM method, we will take net profit margin. Okay. See, every time we do not know GP margin. Sometimes we are going to take net profit margin. Okay. See, we rely on certain websites for GP margin of the industry. However, many times in those websites also, whatever the data available, it will not give gross profit margin, it will give only net profit margin. So sometimes based on net profit margin, we are going to calculate arm's length price using transactional net margin method. Are you able to understand? So what you will do, whatever the cost that you have incurred for providing services to your associated enterprise, take that cost, whatever the net profit margin that is levied by unrelated parties is there, add that net profit margin and thereby you calculate arm's length price. Okay, so let's calculate, let's do one problem with regard to transactional net margin method. You will easily understand. Actually, in CMA workbook, no problem is not available with regard to TNMM method. So I am going to discuss now. I am going to discuss now in this in my material. Please see. Yeah, question number 24. I request everyone to open question number 24. Yes, please open question number 20. Ants INC has its business in Malaysia, has advanced a loan of Malaysian dollars or Malaysian dinars 1,60,000 to Ants Limited India. So there are two companies, Ants Limited, Ants INC. So how much loan is given? 1,60,000 Malaysian dollars. Book value of total assets of Ants Limited was 125 lakhs. So how much is book value? Book value of total assets. $125. Now here at the end of the question, it was given 1 Malaysian dollar is equal to 45 rupees. That means convert into Indian rupees. How much loan was given? 1,60,000 into 45, 72 lakhs loan was given. Do percentage, how much percentage of loan was given? Percentage, 72 lakhs divided by 125 lakhs into 100. 57.6%. That means more than 51%, correct? If more than 51% loan is given, then if more than 51% of assets amount is given as loan, then both will be treated as associated enterprises, correct? Now, next. Ants Limited provided software backup support to Ants Inc. Ants Limited has spent 50,000 man hours during financial year 24-25 for services rendered to Ants Inc. So, how many hours of service is provided? 50,000 man hours. How much is cost? Cost is 75 Malaysian dollars per man hour. 75 Malaysian dollars per man hour. How much is billing? Billing is 90 Malaysian dollars per man hour. Okay. Sorry, 90.75. I am very sorry. Same, this type of clerical mistake I have done in previous problem. After entire calculation, I realized this clerical error. So that's why now I have my student Priyatam. He is going to rectify all these mistakes, but he did not reply to this. Next. Gamma Limited in India, which has similar business model, provides software backup support to Olive Inc. in Penang, Malaysia. Gamma Limited's cost and operating profits are as under. So how much? Direct cost 600, indirect cost 200, operating profit is 200. So can we calculate operating profit margin? We can calculate. So in case of Gamma Limited, it's okay, Priyatam, don't feel bad. I just casually said. Operating margin as a percentage of cost. As a percentage of cost. How much is operating margin? Operating margin is 200 rupees. How much is cost? Cost is 800 rupees. 200 by 800 into 100. So how much is operating margin as a percentage of cost? 25. So what we will do now? We will take total cost. To total cost, we will add GP margin. Thereby, we are going to calculate arm's length. Okay. Now, how much is total cost? Shall we calculate total cost? Total cost is equal to 50,000 man hours into how many Malaysian dollars? Cost 75 rupees, correct? 50,000 into 75. 37,50,000 Malaysian dollars. Correct. To this we will add GP, gross profit, and it is as a percentage of cost. You can directly apply GP at the rate of 25%. How much? 9,37,500 Malaysian. So how much is arm's length price? Arm's length price is 46,87,500 Malaysian dollars. How much is billing done? Billing 50,000 man hours into 90.75 Malaysian dollars. 45,37,500 Malaysian. So that means under sales were done, under billing was done. How much is under billing? Under billing is 1,50,000 Malaysian dollars, correct? Now convert underbilling into rupees. Here underbilling is in Malaysian dollars. Now calculate underbilling in Indian rupees. How much? 1,50,000 into 45. 67,50,000 rupees. Correct? So somewhere it went wrong. Yeah, 67,50,000. That's the arm's length. I mean, that is the addition of income. Whatever the underbilling is done, this 67,50,000 will be added to income of S. Okay. So this is about transactional net margin, TNMM. Next, advance pricing agreement, rollback provisions, secondary adjustment, section 94B, very important, thin capitalization, amount of interest payable to associated enterprise. These concepts I am going to discuss in revision lecture part 3. Okay. Range concept and advance pricing agreement. Very important. Please listen till the end. Okay. So coming to the topic, till now we have discussed various methods to calculate arm's length price. Some of the students will get a doubt. Sir, what if more than one arm's length price is available? If more than one arm's length price is available, then you have to take average of arm's length prices. For example, let's say there is one transaction. AA Limited sold goods to BB Limited. Okay. Let's say they are sold for sale price is equal to 38,000 rupees. Now, same AA Limited sold goods to CC Limited for 38,500. Same AA Limited sold goods for DD Limited for 38,900. Same AA Limited sold goods to EE Limited for 39,100. That means three arm's length prices are available. Arm's length price 1, arm's length price 2, arm's length price 3. So, if more than one arm's length price is available, then what you have to consider? You have to consider average arm length price. Here, how much is average arm length price? 38,500 plus 38,900 plus 39,100 divided by 3. How much it is? 38,833. That will be considered as average arm's length price. Okay. Did you understand? Sir, if we have 10 arm's length prices available, then also we will take average? No. If arm's length prices available are up to 5, that means if 5 arm's length prices are available, then you will consider average arm length price. Okay. If 6 arm's length prices are available, then range concept is applicable. So like if more than one arm's length price is available and up to 5 arm length prices are available, then you will take average arm length price. If arm's length prices available are 6 or more than 6, then you are going to apply range concept. How to apply range concept, I will discuss little later, but till now you understood, right? If more than one arm's length price is available and up to 5 arm length prices are available, what you will take? You will take average arm length price, correct? Then what you will do? You will compare average arm length price with actual price. You have to compare average arm length price with actual arm length price. If deviation is less than or equal to 3% of actual price, okay, then actual price will only be taken as arm length price. Are you able to understand? If deviation is more than 3% of actual price, more than 3% of actual price. In that case, arm's length price is equal to average arm length price. Okay, that is the formula. So very simple. You will compare average arm length price with actual price. The difference between these two, if it is less than 3% or equal to 3%, then actual price will only be taken as final arm's length price. If deviation is more than 3%, then average arm length price will be taken as final arm length price. Are you able to understand? Now, let us see how much is average arm length price. Average arm length price. Here, average arm length price is 38,833. Next, actual price. How much is actual price? 38,000. Correct. How much is deviation? Deviation is 833 rupees. How much is percentage of deviation? Percentage of deviation is equal to 833 divided by 38,000 into 100. Calculate the percentage. 2.192%. That means it is less than 3%. As it is less than 3%, arm's length price is equal to actual. How much is actual price? Actual price is equal to 38,000. So in this case, 38,000 itself will be taken as. Are you able to understand? So what you have to do, you have to compare actual price and average arm length price. Difference between average arm length price and actual price is less than 3% or equal to 3%. Then actual price will only be taken as final arm length price. If deviation difference is more than 3%, in that case, whatever the average arm length price is there, that will be taken as final arm length price. Did you understand? So this concept, average arm length price concept, is applicable only up to 5 arm length prices. If you have 6 arm length prices or more than 6 arm length prices, in that case range concept is applicable. Now I am going to explain you the range concept. It is newly introduced. Till now only MCQs were asked, main question was not asked, yet range concept is important. Okay. For example, and one more thing, there are 5 methods to calculate arm's length price. CUP method, comparable uncontrolled price method, resale price method, cost plus method, profit split method, TNMM, transactional net margin method. Out of 5 methods, only for 4 methods range concept is applicable. Okay, what are 5 methods? CUP, resale price method, cost plus method, profit split method, transactional net margin method. See, for these 3 methods, range concept is applicable. For TNMM also range concept is applicable. However, for profit split method, range concept is not applicable. So range concept is basically applicable only for 4 methods: CUP, resale price method, cost plus method, transactional net margin. Okay. And when you have 6 or more arm length prices in data set, 6 or more arm length prices in data set, then range concept is applicable. That means what? Up to 5 arm length prices, range concept is not applicable. Up to 5 arm length prices, you can take average arm length price. Are you able to understand? Shall we see one example for better understanding? For example, arm length price 1, 141, 2, 162, 3, sorry, 163, 152, 156, 137, 169, 166. Okay. First of all, when you are going to apply range concept, here you need to apply range concept because how many arm length prices are available? 7 arm length prices are available in data set. So you have to apply range concept. Before you apply range concept, you have to arrange the data. You please arrange the data in ascending order. You know ascending order, right? Lower to higher. Arrange them in ascending order. Okay. Arrange. What is the lower among all? 137, right? 137. Next, 141. Next, 152. Next, 156. Next, 163. Next, 166. Next, 160. So first, many students they forget whatever the data that is given. Based on the data they will calculate range. Answer will go wrong. Remember, accident spot. Many times students will forget. First of all, you have to organize the data in ascending order. Okay, you should not forget. After you organize the data in ascending order, see, you know range, right? Range means lower point to higher point. Okay, lower point is 35th percentile. Lower point 35th percentile, higher point 65th percentile. Okay, so 35th percentile, shall we calculate 35th percentile? That means how many arm's length prices are available in data set? 7 arm length prices are available in data set. 7 into 35%, how much? 2.45. See, but 2.45 is not available. 2.545 is not a whole number. So what you have to take? You have to take next number. 2.45 is not a whole number. So what you will take? You will take third one. So third one is lower percentile. 152 is lower percentile. Lower point. Okay. Next. How much is higher point? Higher point is 65th percentile. 7 into 65%, how much? 4.55. You will round off to whether 4.55 is whole number. No, it is not a whole number. Round off to next number. Next number is 5. So in data set, whatever the fifth one is there, fifth one is higher point. So what is the range here? Range here is lower point is 152, higher point is 163. So this is the range. So we found out the range. Now the point is, if actual transaction price falls in the range, then happy, arm's length price is equal to actual transaction price, no deviation. Whatever actual transaction price is there, that itself will be taken as our arm length price. Are you able to understand? See, actual transaction, whatever the actual transaction is there, if that actual transaction falls within the range of 152 to 163. For example, in this case, Arha Limited sold goods to Bob Limited for rupees 150. Now how much is actual transaction price? Actual transaction price is 150. Okay. Tell me one thing, whether 150 falls within the range, whether 150 falls within the range of 152 to 163? No. If actual transaction price falls within the range, then actual transaction price will be taken as arm length price. But if actual transaction price do not falls in range, in that case, arm's length price is equal to 50th percentile. Okay, 50th percentile. Here actual transaction price is 150, but 150 is not within the range. Range is 152 to 163. Whether 150 is falling within the range of 152 to 163? No. So in this case, arm's length price is equal to 50th percentile. 7 into 50%, how much? 3.5. Whether 3.5 is whole number, 3.5 is not a whole number. Okay, you will round off to next. Next one, round off to next one means 4. So whatever the amount in fourth one is there, this we will take as arm length price. So arm length price here is equal to 150. Are you able to understand? So very simple. Range. First you have to calculate lower point, then you have to calculate higher point. Lower point is 35th percentile, higher point is 65th percentile. When you calculate percentile, if you do not get whole number, you have to round off and you have to take the next number. First you have to define the range, lower point to higher point. If actual transaction falls within the range, happy. Actual transaction is only arm length price. But if actual transaction do not fall in the range, in that case, arm's length price is equal to 50th percentile. Are you able to understand? Now, students will get doubt. Sir, what if it is not a whole number, you will round off. What if it is whole number? If it is whole number, then how are we going to calculate arm's length price? That I am going to tell you with another example. Okay. For example, there are 20 arm length prices. Don't worry, I will not write all of them, but just listen. 121, 126, 127, 129, 134, 136, 138, 140, 143, 144, 148, 152, 154, 158, 160, like this up to 200. Okay, 20 arm length prices are available starting from 121 to 200. So in data set, how many arm length prices are available? In data set, 20 arm length prices are available. Now will you take average? You should not take average. What you have to take is range. Range concept is applicable. Correct? Now how much is lower point? Lower point is 35th percentile. Correct? That means 20 into 35%. How much? 20 into 35%, 7. Whether 7 is whole number? Yes, 7 is whole number. Now, so whatever 138, okay, 7th one, 138, this will be considered as lower point, correct? Your answer is wrong. You should not take like that. Whenever you get whole number, you have to take 7th plus 8th divided by 2. Okay, how much is 7th? 7th is 138, 8th one is 140 divided by 2, 139. So 139 will be considered as 35th percentile. Are you able to understand? So my dear students, please remember, when you apply 35th percentile, if you get whole number, don't take whole number directly. Whole number plus immediately next number divided by 2 is lower percentile. Are you able to understand? So 139. Next. Higher point. Higher point is 65th percentile, 20 into 65%, how much? 13, correct? Sir, will you take 154 as higher point? Your answer is wrong. Your answer is wrong because it is whole number. Whenever you get whole number, you have to take whole number plus immediately next number divided by 2. So 13th plus 14th divided by 2. How much is 13th? 154. 14th 158 divided by 2. How much? 156 is highest point. Okay. Now, shall we define range? Lower point to higher point. How much is lower point? Lower point is 139, higher point is 156. So 139 to 150. So did you understand? This is the range 139 to 156. If actual transactions falls within the range, then no problem. Actual transaction is only arm length price. But if actual transaction do not fall in the range, in that case, like arm length price is equal to 50th percentile. 50th percentile means 20 into 50%, 10. 10 is whole number, right? Will you consider 10? No, you will not consider 10. What you have to consider? You will consider 10th plus 11th divided by 2. Okay. So how much is 10th? 10th is 144, 11th is 148. So 144 plus 148 divided by 2. How much? 146. That will be taken as arm length price. Are you able to understand? So very simple. If actual transaction falls within the range, actual transaction is only arm length price. If actual transaction do not fall in the range, then arm length price is equal to 50th percentile. Careful. After you apply percentile, the answer is whole number. You have to consider whole number plus immediately next number divided by 2. Okay. If it is not whole number, happy, you will round off to next. Correct. I hope you got clarity about range concept. Next, we will discuss APA, Advanced Pricing Agreement. Tell me one thing. Advanced Pricing Agreement. See, there is lot of confusion in calculation of arm's length price. I will follow cost plus method. Tomorrow department will do assessment. Department will tell, no, you should not calculate using cost plus method. You have to calculate using transactional net margin method. So lot of like differences of opinion will be there. SSC will calculate in one way, department will calculate in another way. I will take data. Like, see, to calculate arm's length price, we need third party data. I took third party data from Capital Line website. Department will tell, don't take from Capital Line website. Department will take information from another proviso website. So there is lot of confusion with regard to calculation of arm's length price. So whenever there is lot of differences of opinion, there will be lot many disputes, right? I will tell cost plus method is correct. Department will tell transactional net margin method is correct. I will file appeal. Both will fight. Cases will never end. So lot of confusion is there. Lot of disputes is there. So to reduce disputes, like the government came up with concept called advanced pricing agreement. Sir, what advanced pricing agreement means? See, CBDT, Central Board of Direct Taxes, SSC, both will sit together on one table. They will discuss what is the actual transaction. and they will come to one understanding how arm's length price is calculated, which method is used to calculate arm's length price, what is the base data that is used to calculate arm's length price. So like one side CBDT, another side SSC, both will sit together, okay, they sit together and they negotiate and finally they will come to conclusion regarding how to calculate arm length price. And method used to calculate arm length price, base data used to calculate arm length price. Okay, method to calculate arm length price, base data to calculate arm length price. With regard to these points, they will come to understanding and they will write an agreement. That agreement we call as advance pricing. Are you able to understand? So once CBDT and SSC, after discussions, after negotiations, they will come to understanding what is the method that they will follow to calculate arm length price, what is the base data that they use to calculate arm length price. So after discussion, they will come to understanding and they will write one agreement. That agreement only we call as advance pricing agreement. Once advance pricing agreement is signed by income tax department and signed by SSC, then afterwards arm's length price will be calculated as per the advance pricing agreement only. No confusion will be there, everything is clear. Department knows, SSC also knows how arm's length price is calculated. Department knows, SSC also knows what is the method used to calculate arm length price. So peaceful, happy, okay, there is no confusion, everything is as per the agreement only. So if SSC and CBDT both enter into one agreement for calculation of arm's length price, that agreement we call as advance pricing agreement. To reduce disputes, to reduce confusion, advance pricing agreement concept was introduced. But government will give approval to CBDT for entering into advance pricing agreement. Then SSC is required to make application. After SSC make application, then both will sit on table and they will discuss and they will write one agreement. Are you able to understand? That agreement we call as advance pricing agreement. Is it clear? So first of all, who have to take the initiation? Department will not come to you. You have to apply for department. After you apply to department, department will take approval of central government. Department and SSC both will sit together and they write one agreement called advance pricing agreement. Are you able to understand? If you want to apply for advance pricing agreement for any previous year, then before starting of the previous year only, you have to make application for advance pricing agreement. For example, for previous year 24-25, you want to enter into advance pricing agreement. Appa. You want to enter into Appa. In that case, before starting of 24-25, before 1st April 2024, you have to make application for entering into advance pricing agreement. Let's say you applied on 10th March 2024. On 10th March 2024, you made application for entering into advance pricing agreement. Okay, then yeah, one doubt of Preetham, sir, if any person doing the same transaction, can he also adopt the APA of another party? No. Advance pricing agreement is sole. Advance pricing agreement is independent. Income tax department and the SSC who is entering into advance pricing agreement. Only for those two persons that APA is applicable. For third party, same advance pricing agreement is not applicable. If third party wants, he has to enter into separate advance pricing agreement with CBDT. Okay. Next, sir, on 10th March 2024, SSC made application for entering into advance pricing agreement. Sir, for how many years advance pricing agreement can be entered? Advance pricing agreement can be entered for 2 years or 3 years or 4 years, like that. But maximum APA can be entered for 5 years. Maximum advance pricing agreement can be entered for 5 years. Anyone who is applying for advance pricing agreement, 95% they will apply for 5 years. The reason is advance pricing agreement. The discussion itself will take more than 1 year, 1.5 year. If you apply advance pricing agreement only for 1 year, by the time agreement is completed, already that year will be completed. Are you able to understand? That's why generally it will take 2 years, 1.5 year to enter into advance pricing agreement. If you apply for APA only for 1 year or 2 years, by entering into agreement only, that period will be completed. That's why advance pricing agreement in majority of the cases, it will be entered for 5 years. Are you able to understand? So here we applied APA for 24-25. 24-25 plus next 4 years also you can make application. You can make application for 25-26, 26-27, 27-28, 28-29. Okay. Now, sir, whatever the advance pricing agreement is there, whether advance pricing agreement, can it be applicable for earlier period? Yes, you can make application. See, Abhi, right now you are applying for advance pricing agreement for 24-25. From 24-25, you can make application up to 5 years. Sir, before 24-25 also, if we want same advance pricing agreement, can we make application? Yes, you can make application. That concept we call as rollback provisions. Okay, you can make application for APA for 4 years before 24-25. Okay, that means for 23-24, 22-23, 21-22, 20-21. Okay, this we call as rollback provisions. Okay, this concept we call as rollback provision. But if you want to make application for rollback provisions, you need to pay 5 lakhs fees. Along with APA application, you are right now applying for APA from 24-25 onwards for next 5 years. For earlier years, for rollback also you can make application, but the point is you have to pay additional 5 lakhs as fees. Are you able to understand? That means technically you can apply APA for 9 years. You can enter into advance pricing agreement for 9 years. 24-25 onwards 5 years. Before 24-25 you can make application for 4 years. Are you able to understand? For rollback also you can make application. Now some students will get doubt. Sir, APA we are applying for 5 years. Rollback we are applying for 4 years. Sir, in these 4 years, can we apply only for 1 year? Only for 1 year or 2 years? That means what? Backwards. Backwards, can you apply only for 1 year or 2 years? Not possible. Once you are making application for rollback provisions, then you have to apply for all the 4 earlier years. Are you able to understand? Like earlier, you cannot apply only for 1 year. You cannot apply only for 2 years. Once you decided you wanted same advance pricing agreement applicable for earlier years, then you have to apply for all 4 earlier years. Are you able to understand? That we call as rollback. Am I audible clearly now? Am I audible? Preetham, please confirm. Now, so once you decide to apply for rollback, you have to make application for all 4 years. Are you able to understand? Now, rollback is there, APPA 5 years is there. Sir, we wanted only APPA. We don't want rollback. We wanted only APPA. Is it possible? Yes, possible. We don't want advance pricing agreement for 5 years. We wanted only rollback provisions. Is it possible? Not possible. Are you able to understand? That means what? Definitely you have to enter into APPA for 5 years. Once you enter into APPA, rollback is optional. If you want rollback, you can apply for rollback. If you don't want rollback, leave the rollback. Are you able to understand? So the thing is, APPA is mandatory. Once you enter into APPA, rollback is optional. If you want rollback, apply rollback. Otherwise, don't apply for rollback. Marriage is mandatory. Children are optional. If you want children, okay. If you don't want, okay. But first you should get married. First you should get entered into advance pricing agreement. Then rollback is optional. Okay. One doubt here. Can transactions be revised in rollback period by considering advance pricing agreement? Preetham, I will come to your point. Hold on for some time. Okay. You understood this point, right? Advance pricing agreement mandatory. If you want rollback, you can apply for rollback. Otherwise, need not apply for rollback. Rollback is not mandatory. Rollback is optional. So, application for APPA was made on 10th March 2024. Let's say application signed on application signed on 9th December 2026. When application advance pricing agreement was signed, advance pricing agreement was signed on 9th December 2026. APPA signed. That means technically advance pricing agreement is completed. That agreement was done on 9th December 2026. See, 9th December 2026. By this time, already previous year 24-25, previous year 25-26 ITRs filed, correct? And by this time, last 4 years also 23-24, 22-23, 21-22, 20-21. These years also ITRs filed, right? That means the date on which advance pricing agreement is entered. By that date, already earlier years income tax returns were already filed. Now, whatever ITRs of earlier years that are filed are there, they can be modified by applying advance pricing agreement. Are you able to understand? They can be modified by applying advance price. For example, you followed resale price method, but in advance pricing agreement, you agreed you will follow comparable uncontrolled price method. When you filed ITR, see, previously you followed resale price method. As per advance pricing agreement, you agreed CUP method, comparable uncontrolled price method. That means earlier ITR was filed using resale price method. Am I correct or not? Now, advance pricing agreement may you have to follow comparable uncontrolled price method. In income tax return, you followed resale price method. Now you will modify income tax return. You will modify income tax return and you will recalculate all transactions using comparable uncontrolled price method and you will file modified income tax return. Are you able to understand? Sir, within how much time we have to file modified income tax return? Modified ITR. Modified ITR. It should be filed within 3 months from end of month in which APPA is entered. In which APPA entered. What do you mean by this? When advance pricing agreement was entered, advance pricing agreement was entered on 9th December 2026. How much is end of month? End of month is 31st December 2026. From 31st December 26, you have to take 3 months. That means 31st March 2027. Before 31st March 2027, you have to file modified return for all earlier years for which you have filed the item. Are you able to understand? I hope your doubt got solved, Preetham. Now, see how many 4 years? These 4 years are rollback years, right? For example, for 2021, already assessment is completed. Assessment completed. But when you enter into advance pricing agreement, even the assessment is completed for 2021, modified assessment will be done because earlier assessment was done following resale price method. Now modified assessment will be done following advance pricing agreement. Are you able to understand? So if any assessment is already completed for rollback years, then modified assessment will be conducted by income tax department. One doubt was asked, as the application date and advance pricing agreement sign dates are different, when will the APPA apply and rollback period apply? See, application was made on 10th March 2024. APPA signed on 9th December 2026. For all these years, from 24-25 onwards, APPA is applicable. 24-25 onwards, 5 years. 24-25 before, 4 years, APPA is applicable. Advance pricing agreement is applicable. That means the period for which application is made, for this period APPA is applicable the moment agreement is signed. Even the agreement is signed in 26-27, that advance pricing agreement is applicable from 23-24 onwards. Okay. Now another question, sir, for 21-22 assessment is pending. If assessment is pending, then that assessment will be completed based on advance pricing agreement. Are you able to understand? That means what? For earlier years, already by the time you enter into advance pricing agreement up to 25-26, all ITRs were filed, right? You entered agreement on 10th December 2026. By 10th December 26, already 6 years ITRs were filed. In last 6 years, for any assessment is pending, that assessment will be completed as per advance pricing agreement. For last 6 years, if any assessment is already completed, then modified assessment will be done based on advance pricing agreement. Are you able to understand? For example, in 22-23, there is one matter. On that matter, appeal was filed and judgment was given. Once judgment is given, then there is no APPA, no advance pricing agreement, no modification. Are you able to understand? That means what? For earlier years, for any matter, if any appeal is filed and judgment is given by ITAT or High Court or Supreme Court, if any matter is already concluded, now that matter will not be revised. That matter will not be modified. For that matter, advance pricing agreement is not applicable. Are you able to understand? However, if any assessment is pending, that is with the department only, that can be modified. If anything is already concluded, either by ITAT, High Court or Supreme Court, then no concept of application of APPA, no modification will be done. Are you able to understand? Conditions for rollback provisions. Conditions for applicability of rollback provisions. There are 3 conditions. How many conditions? 3 conditions. Condition 1, you have to international transaction should be same for rollback years. Condition 2, ITR should be filed within due date under section 139(1) for rollback years. Condition 3, tax audit report under section 92E is to be submitted within due date for rollback years. Then only you can make application for rollback provisions. Otherwise, rollback provisions are not applicable for that year for which any one of these conditions are not satisfied. What do you mean by this? For example, you are into chocolate business. Okay, you entered into advance pricing agreement for chocolate business. In rollback years also, in last 4 years also, you should be into chocolate business transactions only. If you are into biscuit transactions, biscuit business transactions, then advance pricing agreement is not applicable for rollback years. Are you able to understand? That means the advance pricing agreement which you are entering, okay, for which international transaction you are entering, the same international transaction should also happen in rollback years. Then only advance pricing agreement is applicable. Are you able to understand? For example, like in 24-25, you are entering into advance pricing agreement for chocolate business, chocolate related international transactions. Even in earlier years, 23-24, 22-23, 21-22, 20-21, like the international transaction is also should be relating to chocolate business. Then only rollback provisions are applicable. Otherwise, rollback provisions are not applicable. So international transaction should be same in rollback years also. Then only rollback provisions are applicable. Next, last 4 years, right? 23-24, 22-23, 21-22, 20-21. For example, in 22-23, you filed ITR lately. If you file ITR lately, then rollback provisions are not applicable. Are you able to understand? Rollback is not applicable. For 2021, tax audit report filed lately. When you file tax audit report lately, then also rollback provisions are not applicable. So I hope you are understanding. Whatever the international transaction for which you are entering into advance pricing agreement, same international transaction should also be there in rollback years. That is condition 1. For all rollback years, you have to file ITR within the due date. Then only like rollback provisions are applicable. For all the 4 rollback years, you have to submit tax audit report. Then only rollback provisions are applicable. Otherwise, rollback provisions are not applicable. Are you able to understand? Now, advance pricing agreement, APA. APA is not applicable if there is change in law or change in fact. Change in law or change in fact. What do you mean by this? For example, you entered into advance pricing agreement in 24-25. At that time, Income Tax Act 1961 is there. In 25-26 or in 26-27, Income Tax Act 2025 came. See, when you entered into advance pricing agreement, you entered based on Income Tax Act 1961. When you but in 26-27, there is change in Income Tax Act, new Income Tax Act came, Income Tax Act 2025. Whether advance pricing agreement is applicable in 26-27? No, advance pricing agreement is not applicable, because in 26-27 there is change in law. Once there is change in law, advance pricing agreement is no longer applicable. Are you able to understand? Next, if income tax department comes to know APA is entered fraudulently, that means APA is entered fraudulently. For example, I am into steel manufacturing business. I entered into advance pricing agreement telling I am into iron manufacturing business. I did not disclose proper facts. I am into steel business, but entering into advance pricing agreement, I told I am into iron manufacturing business. So I have misleaded the income tax department. I have given the wrong information. I have entered into advance pricing agreement fraudulently. In that case, APA is void ab initio. Void ab initio means what? Advance pricing agreement is cancelled from the beginning. Advance pricing agreement is void from the beginning. Okay, void ab initio. Are you able to understand? Next, two last points are there. Due to APA, due to advance pricing agreement, if your income decreases below ITR income, then advance pricing agreement is not applicable. APA is not applicable. Sir, what you are saying? Why will we enter into advance pricing agreement? So that if we enter into advance pricing agreement, our income decreases. If our income decreases, our tax liability also decreases. But you are saying because of advance pricing agreement, if there is decrease in income, APA is not applicable. Sir, one side you are saying if you enter into APA, your tax decreases. Another side you are saying if you enter into APA and if your income decreases, advance pricing agreement is not applicable. Sir, it is confucius. Please clarify. I will clarify. Don't worry. Okay. For example, ITR income. ITR income is 70 lakhs. Income tax officer has done the assessment. As per assessment, income is 85 lakhs. Sorry, as per assessment, income is 95 lakhs. Now, I entered into advance pricing agreement. By entering into, because of advance pricing agreement, my total income is 80 lakhs. Whether advance pricing agreement is applicable? Yes, APA is applicable. Are you able to understand? This is case 1. Case 2. By entering into advance pricing agreement, total income is 68 lakhs. 68 lakhs means it is less than 70 lakhs, right? In this case, advance pricing agreement is not applicable. Are you able to understand? So, after entering into advance pricing agreement, because of advance pricing agreement, if your income is below assessed income, happy, advance pricing agreement is applicable. Here you can see your income is less than 95 lakhs. Even though your income is less than 95 lakhs, advance pricing agreement is applicable. But if your income is less than ITR income, then advance pricing agreement is not applicable. Are you able to understand? Rollback provisions are applicable only if SSC is in existence in rollback years. What do you mean by this? For example, Reliance Limited got demerged. Reliance Limited got demerged into Reliance Limited and Zio Limited. Let's say this demerger happened in previous year 24-25. You have entered into advance pricing agreement for previous year 25-26 for Geo Limited. Now for Geo Limited, whether rollback provisions are applicable, rollback provisions are not applicable because Geo Limited came into existence in 24-25. In 23-24, 22-23, 21-22, whether Geo Limited is in existence, Geo Limited is not in existence. Okay, as Geo Limited is not in existence, rollback provisions are not applicable. Are you able to understand? So rollback provisions are applicable. Hello CMA final students. Now in part 4 of transfer pricing, I am going to explain two most important sections. First one is section 92 CE secondary adjustment. Afterwards, I will discuss section 94B thin capitalization, interest paid to associated enterprise. Section 94B is very important. In last 2-3 attempts, in every attempt one question, 7 marks question is asked from section 94B. That much important it is. So this lecture is very important and useful. If you listen to this lecture, definitely you can score 7 marks. Okay, so don't pause this video, don't stop watching this video, watch this video till the end. Okay, first secondary adjustment. Before I discuss with you secondary adjustment, you all know primary adjustment, right? First let us discuss primary adjustment. Let's say there are two companies, Rama Limited and there is Bob Limited. Rama Limited is basically Indian company, Bob Limited is basically company located in USA. But Bob Limited holds 36% shareholding in Rama Limited. So we can tell Rama Limited and Bob Limited as associated enterprises. Correct? Now, Rama Limited sold goods to Bob Limited. Actual sale is 10 crores. Okay, but arm's length price sale is 4 crores. Generally, under sales are there. Actually, there should be arm's length price sales are 14 crores. Actually, they should be sold at 14 crores. But with associated enterprise, what is the sale price at which they are sold? They are sold for 10 crores. Now, how much is under sale? Under sales. Under sales are 4 crores. 4 crores will be added to income of SSC. Now, whatever 4 crores added to income of SSC is there, this we call as primary adjustment. Okay, primary adjustment. 4 crores. Did you understand? That 4 crores we call as primary adjustment. Now the point is, actually goods should be sold for 14 crores, but goods are sold only for 10 crores. Whatever the 4 crores is there, this is excess money. That excess money is lying with Bob Limited associated enterprise. Actually, Bob Limited should give 14 crores. But whether Bob Limited gave 14 crores to us? No. Bob Limited gave only 10 crores to us. Excess money 4 crores lying with Bob Limited. Now, whatever excess money of 4 crores is there, money of 4 crores should be brought to India within 90 days. Should be brought into India within 90 days. Sir, from which date 90 days is calculated? That I am going to explain little later. But the thing is, 4 crores should be brought into India within 90 days. Whatever the excess money with Bob Limited, it should be brought into India. If excess money is not brought into India, excess money is not brought into India, then not brought into India within 90 days. In such case, 4 crores will be deemed as loan given to associated enterprise, loan given to Bob Limited being associated enterprise. Okay, now whatever 4 crores deemed as loan is there, this we call as secondary adjustment. Are you able to understand? The point is, whatever the excess money of after comparing with arm's length price, that excess money is to be brought into India within 90 days. If excess money is not brought into India within 90 days, then excess money will be deemed as loan given to associated enterprise and interest income will be added. And interest income will be added. Till such amount is brought back to India. Till how much period that interest income will be added? Interest income will be added till such amount is brought into India. That concept we call as secondary adjustment. Primary adjustment means excess money. We will add excess money to the income of the SSC. Now whatever the excess money is there, that should be brought into India. If it is not brought into India, that excess money will be deemed as loan given to associated enterprise, and every year interest income will be calculated, and such interest income will be added to total income of the SSC till that excess money is brought into India. That concept we call as secondary adjustment. Are you able to understand? Now, next, I told excess money should be brought into India within 90 days. Sir, from which date 90 days is calculated? That we will see. See, secondary adjustment is not applicable in every case. Secondary adjustment is applicable in 5 cases. What do you mean by secondary adjustment? Excess money should be brought into India within 90 days. If it is not brought into India, it will be deemed as loan given to associated enterprise and interest income will be added. Such addition of interest income, if excess money is not brought to India, we call as secondary adjustment. Okay, the concept of secondary adjustment applicable in 5 cases is applicable in 5 cases. Case 1, SSC made primary adjustment on his own motion. That means what? SSC himself calculated the arm's length price. If SSC himself calculates the arm's length price, then SSC is required to bring excess money to India within 90 days from ITR due date. Are you able to understand? So, excess money to be brought into India within 90 days from ITR due date under section 139(1). Did you understand? That is case 1. That means SSC himself calculates arm's length price. SSC himself has done primary adjustment. Then SSC has to bring the excess money to India within 90 days from ITR due date under section 139(1). Next, case 2. Assessing officer made primary adjustment and SSC accepted the primary adjustment and SSC accepted primary adjustment. In this case, that means what? I calculated arm's length price as 10 crores. Income tax officer came. He calculated arm's length price as 14 crores. So, as per assessing officer, arm's length price is 14 crores. Excess money 4 crores I have to brought to India. Then 90 days will be calculated from which date? In this case, excess money to be brought to India within 90 days from date of assessment order, within 90 days from date of assessment order. Are you able to understand? Third case. That means the date on which assessment order is came. From the date onwards, within next 90 days, I need to bring excess money to India. If I do not bring that money, it will be deemed as loan given to associated enterprise, and such on such deemed loan, interest income will be added to total income of the SSC till the time that excess money is brought to India. Are you able to understand? Next. Third case. Primary adjustment is due to advance pricing agreement. In part 3, I discussed clearly about APA, advance pricing agreement. Primary adjustment is due to advance pricing agreement. See, if advance pricing agreement, if APA is entered before due date of return of income, if APA entered after due date of return of income, if advance pricing agreement is entered before due date of return of income, then excess money to be repatriated within 90 days from actual ITR filing date. That means whatever the ITR filing date is there, from ITR filing date, you have to repatriate the money to India within 90 days. If advance pricing agreement is entered after due date of return of income, then excess money to be brought into India within 90 days from end of the month in which APA is entered. Advance pricing agreement is entered. For example, let's say APA entered before due date of return of income for previous year 24-25. Okay, let's say APA entered on 10th September 2025. Actually, what is ITR due date? ITR due date is 30th November 2025. Before ITR due date only APA was entered. Okay, APA entered before ITR due date. Now, ITR due date is 30th November 2025, but actual ITR filing date is 12th December 2025. Now, from 12th December 2025, you have to calculate 90 days. Are you able to understand? See, not from ITR due date, from actual date of filing ITR. ITR due date is 30th November. Actual ITR filing date is 12th December. As APA entered before ITR due date, excess money is to be brought to India within 90 days from actual ITR filing date. Are you able to understand? Did you understand? Good. So 90 days from actual ITR filing date. Did you understand? If APA entered after due date of return of income, excess money is to be brought to India within 90 days from end of the month in which APA is entered. What do you mean by this? Let's say for 24-25, ITR due date is 30th November 2025. APA entered on 21st December 2025. APA entered after ITR due date, right? So 21st December 2025, you have to take end of the month. What is end of month? End of month is 31st March 2025. Sorry, 31st December 2025. From end of 31st December 25, you have to take 3 months. 31st March 2026. Within 31st March 2026, 90 days. I am sorry, not 31st March 2026, 90 days. Calculate January 31, February 28, March 31. Correct. 31st March 2026. Within 31st March 2026, excess money is to be brought to India. Are you able to understand? So, very simple. Appa entered before ITR due date, then excess money is to be brought to India within 90 days from actual ITR filing date. If advance pricing agreement is entered after ITR due date, in that case, excess money is to be brought to India within 90 days from end of the month in which Appa is entered. Are you able to understand? Next, case 4 and case 5. If primary adjustment is due to safe harbor rules, case 5, if primary adjustment is due to mutual agreement procedure. These two are not that much important, so that's why I am not teaching here. No question was asked till now from these two, but first three are important. If primary adjustment is done on suo motu basis, then excess money is to be repatriated to India within 90 days from ITR due date. If assessing officer has done primary adjustment and SSC accepted the primary adjustment, then excess money is to be brought to India within 90 days from date of assessment order. Are you able to understand? Next, if primary adjustment is due to advance pricing agreement, in that case, we have to check whether Appa is entered before ITR due date, if Appa is entered after ITR due date. If Appa is entered before ITR due date, excess money is to be brought to India within 90 days from actual ITR filing date. If Appa is entered after ITR due date, excess money is to be brought to India within 90 days from date of within 90 days from end of the month in which Appa is entered. Are you able to understand? This is the scenario. Next, what I said, if excess money is not brought to India within 90 days, then what is the consequence? Interest income will be calculated. Sir, what is the rate of interest? Okay. Interest rate. If transaction is denominated in Indian currency, if transaction is denominated in foreign currency. If transaction is denominated in Indian currency, then rate of interest is SBI 1 year marginal cost of lending rate. Marginal cost of lending rate as on 1st April of previous year. To this, you have to add 3.25%. That is the interest rate. If transaction is denominated in foreign currency, then 6 months LIBOR as on 30th September of previous year plus 3%. Are you able to understand? That is the interest rate. So transaction denominated in Indian currency, SBI marginal cost of lending rate as on 1st April plus 3.25%. If transaction is denominated in foreign currency, interest rate is 6 months LIBOR as on 30th September of previous year plus 3%. Next, sir, from which date interest is calculated? Interest is like for example, ITR due date 30th November of 2025. Within 90 days, excess money is to be brought into India. That means what? December 31, January 31, February 28th February, 28th February 26. On or before 28th February 26, excess money is to be brought into India. For example, before 28-26, excess money not brought into India. If excess money is not brought to India, it will be deemed as loan given to associated enterprise and interest income will be calculated. Now the doubt is, interest income will be calculated from 30th November 2025 onwards, or interest income will be calculated from 28th February 2026 onwards. That means like whether interest income is calculated from beginning onwards or whether interest income is calculated after 90 days. The answer is interest income will be calculated from 30th November 2025 onwards. Are you able to understand? That means like from after ITR due date only interest income will be calculated. Are you able to understand? So that's the point. So you have to bring money within 90 days. If you do not bring money within 90 days, interest income will not be calculated after 90 days. Interest income will be calculated from first day after the ITR due date. Are you able to understand? And here also, you should bring excess money within 90 days from date of assessment order. If you do not bring excess money within 90 days, then from first day after assessment order, interest income will be calculated. Are you able to understand? Here, advance pricing agreement is entered before due date for filing ITR. In that case, excess money is to be brought to India within 90 days from ITR filing date. If not, interest income will be calculated from due date for filing ITR. Here there is a bit of difference. See, to bring money to India within 90 days, from which date you have to calculate? You have to calculate from actual ITR filing date. If you do not bring money within 90 days, then interest income will be calculated. Interest income will not be calculated from actual ITR filing date. Interest income will be calculated from actual date, like ITR due date. Are you able to understand? Here, excess money is to be brought to India within 90 days from end of the month in which APA is entered. If you do not bring excess money within 90 days, then interest income will be calculated. Interest income will be calculated from first day after end of month in which APA is entered. From first day after end of month in which APA entered. So did you understand? See, case 1, case 2, very simple. Case 1, if you do not bring money within 90 days from ITR date, from first day after ITR date, interest income will be calculated. Case 2, you have to bring money within 90 days from date of assessment order. If you do not bring money from first day after date of assessment order, interest income will be calculated. Next, advance pricing agreement. This is careful, super careful you have to be. APA entered before ITR due date. You have to bring excess money to India within 90 days from actual ITR filing date. If you do not bring, interest income will be calculated not from actual ITR filing date. Interest income will be calculated from ITR due date. So 90 days to be brought to India within actual ITR filing date. If not, interest income. Interest income is not from actual ITR filing date. Interest income is from ITR due date. Are you able to understand? From first day after ITR due date, interest income will be calculated. Are you able to understand? Next. If APA is entered after ITR due date, you have to bring excess money to India within 90 days from end of the month in which APA is entered. If you do not bring, from first day after the end of the month in which APA is entered, interest income will be calculated. Are you able to understand? Now let us do one problem so that you will understand better. So this is the problem. Before we do the problem, there is one more point. The point is, sir, in this case, excess money is 4 crores. But how can we bring 4 crores? Is there any alternative without bringing 4 crores? Yes, there is alternative. See, you have two options. Alternative one, bring excess money to India. India within 90 days. Else, interest income will be added. Till you bring back that money. Or alternative two, pay one-time additional tax. You need not bring excess money, but pay one-time additional income tax. Pay one-time additional income tax at the rate of 20.9664%. Okay. So 20.9664%, how much? Tax 18%, surcharge 12%, HEC 4%. Are you able to understand? So the thing is, you have two options. Whatever the excess money is there, bring excess money to India within 90 days. Or it will be deemed as loan and interest income will be added. Every year interest income is added. So it is big burden to us. So is there any other alternative? Yes. You can pay one-time additional income tax at the rate of 20.9664%. So that is alternative 2. If you pay one-time additional income tax, then no more interest income will be added. Okay. Another point is, secondary adjustment is not applicable. When secondary adjustment is not applicable? Not applicable if case A, if primary adjustment is less than or equal to 1 crore. If primary adjustment is less than or equal to 1 crore, then secondary adjustment is not applicable. If primary adjustment is done before assessment year 16-17, because the concept of secondary adjustment is applicable from 16-17 onwards. So before assessment year 16-17, if you have done primary adjustment, then there is no concept of secondary adjustment. And after assessment year 16-17 also, if primary adjustment is less than 1 crore or equal to 1 crore, then there is no concept of secondary adjustment. Are you able to understand? So you have two options. Option 1, bring back excess money to India. Else, interest income will be added. Option 2, pay one-time additional income tax. Whatever secondary adjustment is there, that is not applicable if primary adjustment is less than or equal to 1 crore or if primary adjustment is done before assessment year 16-17. Okay. Now, let us see this question. There is Bahu Limited and there is Balla Limited. Bahu Limited holds 36% shareholding in Balla Limited. Bahu Limited is based in India. Balla Limited is based in USA. In previous year 21-22, Bahu Limited sold 6 crore worth of goods to Balla Limited. Arm's length price on suo motu basis is 8.2 crores. SBI marginal cost of lending interest rate as on 1st April 22 is 11.25%, 1st April 23 is 12%, 1st April 24 is 13%. Bahu Limited decided to pay one-time additional income tax on 1st July 2024. So this is the question. Basically in 21-22, first of all, Bahu Limited, Balla Limited, both are associated enterprise. Why both are associated enterprise? Because they are holding 36% shareholding, which is more than 26% shareholding. So Bahu Limited, Balla Limited both are treated as associated enterprises. Actual sales 6 crores, arm's length price 8.2 crores. So how much is excess money? Excess money is 2.2 crores. 2.2 crores is excess money primary adjustment, correct? Now excess money 2.2 crores should be brought to India. Brought to India within 90 days. See, here arm's length price adjustment is done on suo motu basis. If it is done on suo motu basis, excess money is to be brought to India within 90 days from ITR due date. So, for previous year 21-22, what is assessment year? Assessment year 22-23. What is ITR due date? ITR due date is 30 November 2022, correct? So, from 30 November 2022 within 90 days, calculate 90 days means December 31, January 31, February 28. So 28th February 2023. Before 28th February 2023, excess money is to be brought to India. But when excess money was brought on, no, excess money is not brought to India. One time additional income tax was paid on 1st July 2024. So tell me, in 22-23, whether excess money is brought to India, excess money is not brought to India. Now we need to calculate interest income, correct? Because whatever the excess money is there, that will be deemed as loan given to Balla Limited. And on that loan, we need to calculate interest income, correct? How much is excess money? Excess money is 2.2 crores. 2.2 crores into what is interest rate? SBI marginal cost of lending rate as on 1st April 22, 11.25%. So 11.25% plus 3.25%, okay, into how many days? Interest will be calculated from 1st December 2022 onwards, correct? ITR due date is 30th November. You did not bring money within 90 days. So from first day after ITR due date, from 1st December 22 onwards, you need to calculate interest income. How many days? December 31, January 31, February 28, March 31, okay? 121 days, 121 by 365, how much? 14.5%. 10,57,507 rupees, okay? That will be added to income of SSC. This is for previous year 22-23. Now tell me, in previous year 23-24, whether excess money is brought to India? No. Or in 23-24, whether one-time additional income tax was paid? No. When one-time additional income tax was paid? One-time additional income tax was paid on 1st July 2024. So, for previous year 23-24 also, we need to calculate interest income. How much is interest income? Excess money is 2.2 crores. What is the interest rate? 12% plus 3.25%. For 365 days, you will calculate. That means 2.2 crores into 15.25%. $33,55,000. So did you understand? In 24-25, additional income tax was paid. Additional income tax paid. When additional income tax paid? Paid on 1st July. When additional income tax paid? 1st July 24. Additional income tax paid on 1st July 24. That means 1st April 24 to 31st March 2025. When additional income tax was paid? On 1st July 24, additional income tax was paid, correct? So for this period, 1st April 24 to 1st July 24, we will calculate interest income. After 1st July 24, interest income will not be calculated because he already paid additional income tax. Now, once he pays additional income tax, then interest income will not be added to the total income of SSC till the time he pays additional income tax. When he paid additional income tax 1st July 24, so till 1st July 24 we will calculate additional, like we will calculate interest income, and on 1st July 24 anyhow he paid additional income tax. That's it, there ends the matter. Okay, from 1st July 24 onwards interest income will not be calculated because he already paid additional income tax. Now how much is additional income tax? Additional income tax 20.9664%, correct? So 2.2 crores into 20.9664%, how much? ₹46,12,608. Are you able to understand? Yeah, it's 31st March 25. I am sorry, Preetham. It's clerical mistake. Next, interest income. Interest income will be added for how many days? April 30 days, May 31 days, June 30 days. So total 91 days, correct? So 2.2 crores into what is marginal cost of lending as on 1st April 24? 13%. 13% plus 3.25%. 3.25% into 91 by 365. How much? 8,91,301. Is it the answer? Cross check once. Yes. Now did you understand how secondary adjustment will be done and how interest income will be calculated, how one time additional income tax is paid? I hope you got clarity. So this is all about secondary adjustment. Okay. Now let us see very important concept, section 94B. Thin capitalization or interest on loan taken from associated enterprise. Okay, very important. Definitely one 7-mark question will be asked from this concept. Okay, so be careful, listen this concept very well. There are two companies, A Limited, B Limited. A Limited is based in India, B Limited is based in Australia. Okay, now A Limited has taken loan 100 crores loan in previous year 24-25. Let's say interest rate is 12%, interest at the rate of 12%. Now, how much interest is required to be paid? Tell me, how much interest is payable? Interest is equal to 100 crores into 12%. 12 crores interest is required to be paid, correct? For example, EBI TDA, earnings before interest, tax, depreciation and amortization for 24-25 is 30 crores. Okay, now how much is actual interest paid? Actual interest paid is 12 crores. Whether actual interest paid is allowed as deduction, actual interest paid will not be allowed as deduction. Okay, interest paid to associated enterprise allowed as deduction, allowed as deduction is equal to, what is the formula? Formula is actual interest or 30% of EBI TDA, whichever is lower, 30% of earnings before interest, tax, depreciation and amortization, whichever is lower. How much is actual interest? Actual interest is 12 crores. How much is 30% of EBI TDA? 30 crores into 30%, 9 crores, correct? Whichever is lower means only 9 crores is allowed as deduction. Are you able to understand? So, how much is total interest? Actual interest is 12 crores. Out of 12 crores, 9 crores is allowed as deduction. Remaining 3 crores is disallowed. Sir, is it disallowed forever? No, it is not disallowed forever. Whatever this 3 crores is there, this can be carry forward and set off in subsequent 8 years. Okay, that can be carry forward and set off in subsequent 8 years. See, next year also there will be limit, right? Next year also actual interest or 30% of EBI TDA, whichever is lower. In that limit, you can claim this, you can carry forward this and you can set off in subsequent 8 assessment years within the limit under section 94B. Within the limit under section 94B. Are you able to understand? Very simple. When you take loan from associated enterprise, you will pay interest. Whatever the interest that you pay, total interest is not allowed as deduction. Actual interest or 30% of EBI TDA, whichever is lower, will be allowed as deduction. If there is any interest that is disallowed in current year, that can be carried forward to subsequent 8 years, even in next 8 years also, within 94B limit only, you have to adjust. Some confusion is there, I can understand. We will do one problem, everything will be sorted out. Okay, next. I will explain one interesting case. Okay, just listen. There is Uma Limited and there is Jack Limited. Uma Limited, Jack Limited are associated enterprises. Now, if Jack Limited directly gives loan, 94B applies, correct? So that's why what Jack Limited did, Jack Limited has done fixed deposit of 20 crores with Bank of America. Now, Bank of America, keeping this 20 crores as guarantee, gave loan to Uma Limited. That means Jack Limited is not directly giving loan. If loan is given directly, 94B gets attracted. So what Jack Limited is doing, it is giving guarantee to one bank and bank is giving loan to Uma Limited. Even in this case also, it will be deemed as loan given by associated enterprise. It will be deemed as loan given by Jack Limited associated enterprise. And 94B gets attracted. 94B is applicable. Are you able to understand? So, not only loan given directly by associated enterprise, if associated enterprise gives a security, gives guarantee to third person and third person gives loan to Uma Limited, even in that case also, it will be deemed as loan given by associated enterprise and section 94B gets applicable. Are you able to understand? Next. Next note point, section 94B is not applicable. When section 94B is not applicable, if interest to associated enterprise is less than or equal to 1 crore. That means when you take loan from associated enterprise, you will pay interest, right? If amount of interest is less than 1 crore or equal to 1 crore, then 94B is not applicable. Section 94B applies only if interest paid to associated enterprise is more than 1 crore rupees. Are you able to understand? Next, section 94B is not applicable. Okay, not applicable in case of Indian company or permanent establishment of foreign company engaged in banking and insurance business. See, our associated enterprise is engaged in banking business. In case of banking business, their main business only giving loans and taking loans, correct? So, as part of business, if I take any loan from associated enterprise, then section 94B is not applicable. So, whenever you are taking loan from your associated enterprise, where that associated enterprise is engaged in banking business or insurance business, then section 94B is not applicable. Are you able to understand? Section 94B is not applicable in case of finance company located in IFSC, International Financial Service Center. See, you know IFSC, right? International Financial Service Center. So, any company located in IFSC, it has taken loan from its associated enterprise. Then this formula is not applicable. Actual interest paid, 30% of EBI TDA, whichever is lower, that concept is not applicable. So, whenever any loan is taken by any company that is located in IFSC, in such case also 94B is not applicable. When you take loan from associated enterprise, where associated enterprise is engaged in banking business or insurance business, then also 94B is not applicable. Are you able to understand? So, that's what. Now, shall we do one problem for better clarity? In Institute Workbook, please open section 94B. Rosie Limited provides you profit and loss account for financial year 23-24 and financial year 24-25. So 23-24, 24-25. Employee benefit expense, interest paid to L&T, depreciation, income tax, profit transferred to reserves. On 23rd June 23, Resale Limited, an Indian company, borrowed 120 crores from L&T Inc., a company incorporated in country X. So there are two companies, Resale Limited, L&T Inc. Resale Limited is based in India, L&T Inc. is based in country X. Okay, so loan was taken. How much is loan? 120 crores. Okay. The said loan is repayable over a period of 4 years. This loan is guaranteed by Right Limited, a company incorporated in country Y. So whatever this, there is one company, Right Limited. Right Limited, this is located in country Y. Right Limited gave guarantee to L&T Inc. and Right Limited holds how much shareholding in Resale Limited? Right Limited holds 46% shareholding in Resale Limited. That means Resale Limited and Right Limited are associated enterprises. Whether Right Limited is directly giving loan Is it directly giving loan? No, it did not give loan directly. It gave guarantee. Based on that guarantee, L&T Inc. gave loan to Rosie Limited. Are you able to understand? In this case, whatever the loan given, that will be deemed as loan given by Right Limited, and section 94B is applicable. Are you able to understand? Section 94B gets applicable. Calculate income under the head PGBP for assessment year 25-26. First we will calculate for 23-24, then we will calculate for 24-25. Correct? For 23-24 and 24-25, first let us calculate EBI TDA, earnings before interest, tax, depreciation and amortization. Shall we calculate calculation of EBI TDA? How much is net profit for 23-24? 557 lakhs, correct? For 23-24, for 24-25. $557 lakhs, 403 lakhs, correct? Rupees in lakhs. Now, to this we will add back income tax, correct? Add income tax. How much is income tax? 271 lakhs, 332 lakhs. Thereby we will get earnings before income tax, correct? How much is earnings before income tax? 557 plus 271, 828. 403 plus 332, 735. Now we will add depreciation. How much is depreciation? 250, 254. Now, how much is earnings before tax and depreciation? 828 plus 250, 1078. 735 plus 254, 989. To this, we will add amortization. How much is amortization? Amortization is, so amortization is not there, interest is there. We need to add interest. Interest. How much is interest? Interest paid to associated enterprise, 562 lakhs, 389 lakhs, correct? How much is earnings before interest, tax, depreciation and amortization? 1078 plus 562, 1640 lakhs, and 989 plus 389, 1378 lakhs. Let us check the answer. How much is 1640 EBI TDA, and here EBI TDA is 1378. We got the right answer, right? 1640, 1378. Now how much is actual interest? Actual interest is, first we will do for 23-24. How much is actual interest? Actual interest is 562 lakhs. How much is 30% of EBI TDA? EBI TDA is 1078 lakhs. 1078 lakhs into 30%. How much? 323.4 lakhs. So out of these two, whichever is lower. So how much is interest actually? Actual interest is 562 lakhs. But whether 562 lakhs is allowed? No. Out of 562 lakhs, 323.4 lakhs is allowed as deduction. How much is balance? 238.6 lakhs, that is disallowed in 23-24. Disallowed in 23-24. However, this 238.6 lakhs, it can be carried forward to subsequent 8 assessment years. Are you able to understand? And they can be set off within 94B limit. So you can see in 23-24, how much is allowed? Hey, I am sorry. I did one calculation mistake. It is not 1078. How much is EBI TDA? 1640, right? 1640 into 30%. How much? 492 lakhs. So out of 562 lakhs, how much is allowed? 492 lakhs are allowed as deduction. How much is disallowed? 70 lakhs is disallowed. Are you able to understand? Whatever disallowed 70 lakhs is there, that can be carried forwarded to 8 assessment years within 94B limit. Now, for previous year 24-25, how much is actual interest? Actual interest is 389 lakhs, correct? Actual interest 389 lakhs or 30% of EBI TDA. How much is EBI TDA, earnings before interest, tax, depreciation and amortization? 1378 lakhs, correct? 1378 into 30%. How much? 413.4 lakhs. Out of these two, whichever is lower means 389 lakhs allowed as deduction. Now, in previous year 24-25, how much is 30% of EBI TDA? 30% of earnings before interest, tax, depreciation and amortization is 413.4 lakhs. Out of 413.4 lakhs, 389 lakhs of 24-25 is allowed. Balance is there na? How much balance is left? 24.4 lakhs. From 23-24, how much is brought forward interest from 23-24? Brought forward interest from 23-24 is 70 lakhs, correct? So, out of 70 lakhs, you can set off, out of 70 lakhs, 24.4 lakhs, you can set off in 24-25. Balance 45.6 lakhs, that will be carried forward for next 7 assessment years. Are you able to understand? So, whatever 24.4 lakhs is there, that you can set off. So, 24.4 lakhs you can set off with brought forward interest from 23-24. Are you able to understand? See, this year how much is limit? 413.4 lakhs is limit. But how much is actual interest in current year? Only 389 lakhs. Na? Within balance limit of 24.4 lakhs, you can set off brought forward interest from 23-24. So, brought forward interest is 70 lakhs. Can you set off 70 lakhs? No. Only 24.4 lakhs limit is available. So, out of 70 lakhs, you have set off 24.4 lakhs in 24-25 and balance 45.6 lakhs you will carry forward for next 7 assessment years. Are you able to understand? So, that's the answer. You can see 413.4 lakhs and 45.6 lakhs will be carried forward for 7 more subsequent years. Now, did you understand? 94B, very important. Illustration 7, same just like illustration 6 only, question 6. You please try to do on your own. Very important. Section 94B, definitely one question will come in the examination. Okay. So I hope you are clear. Okay, shall I wind up? Okay, that's it. We discussed the secondary adjustment and section 94B. Thank you very much. Stay tuned for revision of remaining chapters. Thank you. Bye. Now we are going to see penalties under transfer pricing chapter. If you have done any international transaction which constitutes misreporting of income, for misreporting penalty is 200% of tax payable. So whatever the tax liability is there on the transaction on misreported income, whatever the tax is there, 2 times of the tax is required to be paid as penalty. Next, if you do not maintain documentation as per section 92D, or if you do not report transactions, or if you file or if you give any false documentation, okay, incorrect information, in that case how much is the penalty? 2% of value of international transaction, that will be levied as penalty. Next, failure to furnish additional documentation. See, when you are multinational enterprise, you need to submit transfer pricing report of your group to the to the income tax department. If you fail to submit master file, then how much penalty will be levied? 5 lakh rupees penalty will be levied. Next, if you do not failure to furnish information required during proceedings, during transfer pricing proceedings, transfer pricing officer may ask you some information. If you fail to give that information during the proceedings, penalty will be 2% of value of international transaction. If you do not get a transfer pricing report, if you do not get your books of accounts audited by a chartered accountant, then penalty will be 1 lakh rupees. Okay, failure to get books of accounts audited by a chartered accountant. Next, audit report. Every entity which is to whom transfer pricing provisions are applicable, which is doing international transactions, for that entity, it is required to file income tax return. ITR due date is on or before 30th November of assessment year. At least 1 month before ITR due date, you need to submit audit report. So what is due date for audit report? Due date for audit report is 31st October of assessment year. Okay, and audit report will be submitted in which form? It is submitted in the form 3CEB. Okay, next, specified domestic transactions. See, in case of specified domestic transactions, transfer pricing provisions will apply only if aggregate value of specified domestic transactions are more than 20 crores. You can see aggregate of such transactions entered into by SSC exceeds sum of 20 crores. Then only transfer pricing provisions are applicable. Generally, transfer pricing provisions are applicable for international transactions. But what's happening? Let's say there is A Limited and there is B Limited. B Limited is incorporated in India only, but B Limited is claiming deduction under section 10AA, or B Limited is a domestic company paying taxes under 115 BAB, concessional tax rate 15%, or it is cooperative society paying taxes at the rate of 15% under section 115 BAE. Now what will happen? More expenditure will be booked in A Limited and less expenditure will be booked in B Limited. So transactions will be done and more expenditure will be booked in A Limited, so that net profit decreases. Here net profit increases. Even though net profit is increased for B Limited, 100% of profit it can claim as deduction under section 10AA, or it can pay tax at lower rate 15%. So what actually happening? Related parties will be there. Related parties are let's say I am there, A Limited, and there is related party. Related party is enjoying benefit. What is the benefit enjoyed? It is claiming deduction under section 10AA, or it is paying taxes under section 115 BAB at the rate of 15% only. So that means what? Whenever I do transaction with related party, I intentionally increase my expenditure, I reduce my profit, and I will shift my profit to my related party which is claiming deduction under section 10AA, or which is paying taxes at lower tax rate of 15% under section 115 BAB. So what will happen? I will book more profits and I will pay lower taxes over there. So to counter this, transfer pricing provisions are applicable even in case of specified domestic transactions also. But the thing is, aggregate value of transaction should be more than 20 20 crores. Then only transfer pricing provisions are applicable in case of specified domestic transactions. Very simple, like we are doing transaction with our related parties who are claiming deduction under 10AA or 115 BAB or 115 BAE. So what we are actually doing, we are increasing our expenditure, reducing our profit, and we are shifting profit to our related parties. Related parties anyhow paying lower taxes, so we are also paying lower taxes. So to counter this kind of situation, transfer pricing provisions are introduced. Okay. Next, notified jurisdictional area. Whenever you do transaction with any person who is located in notified jurisdictional area, basically if any country is declared as notified jurisdictional area, that country is not supporting to Indian government, that country is not giving information to Indian government. So what Indian government will do, there is one country, Cyprus. Cyprus was declared as notified jurisdictional area. Nowadays not, earlier Cyprus was declared as notified jurisdictional area. Cyprus country used to not give any information to Indian government, so Indian government declared Cyprus as notified jurisdictional area. Now if you do transaction with any person in Cyprus country, that person will be deemed as associated enterprise, that transaction will be deemed as international transaction, and transfer pricing provisions are applicable. Are you able to understand? That means what? Whenever you do transaction with any person located in notified jurisdictional area, even though he is not your relative, even though he is not your associated enterprise, still that party will be deemed as associated enterprise, and that transaction will be deemed as international transaction, and transfer pricing provisions are applicable. But see, all provisions of transfer pricing applicable when you do transaction with a party in notified jurisdictional area, but 3% deviation is not available. See, like you know, right, if more than one arm's length price is available, then average arm's length price will be taken as final arm's length price. If number of arm's length prices are less than 6, you know, right, in that deviation is allowed. If actual transaction price is, if arm's length price is less than or equal to 3% of actual transaction price, then you know, actual transaction price will be taken as final arm's length price. So whatever this 3% deviation is there, this 3% deviation is not available when you do transaction with a party located in notified jurisdictional area, except that remaining all transfer pricing provisions are applicable when you do transaction with a party located in notified jurisdictional area. Now we will discuss safe harbor rules. See, normally whenever you do international transaction, income tax officer will compute arm's length price. Obviously there will be difference and dispute will arise. We will tell one price, income tax officer will tell another price, and income tax officer will do addition. Income tax officer will increase our income, assessing officer. So to counter this kind of scenario, department has released income tax, like lawmakers of Income Tax Act have released safe harbor rules. Safe harbor rules means what? They will keep some margins. If you do transaction within that margin, then whatever your actual transaction price is there, actual transaction price will be deemed as arm's length price. Let's say you are giving corporate guarantee to your associated enterprise. Safe harbor rule is 1% fees. If you charge 1% fees, whatever your actual transaction price is there, it will be deemed as arm's length price. So likewise, that means what? Whenever like some percentages will be prescribed, some margins will be prescribed whenever you do international transaction with your associated enterprise, and if you do transaction within that margin, whatever your actual transaction price is there, it will be deemed as arm's length price, and assessing officer will not again calculate arm's length price. As transfer pricing, audit report, all these are not required. Are you able to understand? So that's what we call as safe harbor rules. SSC has an option to choose safe harbor rules. If SSC chooses safe harbor rules and declares transaction within the margins, then whatever actual transaction is there, it will be deemed as arm's length price. So safe harbor rules are optional. If SSC wants to choose safe harbor rules, he can choose safe harbor rules. I will tell some examples. See, if you are engaged in providing software development services and value of international transactions are less than or equal to 100 crores, then you should declare operating profit margin minimum 17%. That means if your operating profit margin is either 17% or more than 17%, then whatever your actual transaction price is there, it will be deemed as arm's length price. Are you able to understand? Now, you are into software development services. You are providing software services to your associated enterprises located outside India, and value of international transactions are greater than 100 crore but less than or equal to 300 crore. Then minimum you should show 18% operating profit margin. If you do not show 18% margin, then like if you show minimum 18% margin, your actual transaction is deemed as arm's length price. If you show your operating margin less than 18%, then income tax officer will calculate the arm's length price. Are you able to understand? Safe harbor 17%, 18%. If you declare your operating profit margin more than 17%, more than 18%, then whatever your actual transaction is there, that will be deemed as arm's length price. Are you able to understand? Next, you are providing BPO services to your associated enterprises. Then also same, if value of BPO services are less than or equal to 100 crores, then minimum you should disclose 17% operating profit margin. If value of international transactions are more than 100 crore but less than or equal to 300 crore, then minimum you should disclose 18% operating profit margin. Otherwise, if you disclose minimum 18% operating profit margin, whatever your actual transaction is there, that will be deemed as arm's length price. Are you able to understand? Next, you are doing knowledge process outsourcing services, high-end analytics, design, etc. and value of international transaction should be less than or equal to 200 crores. Then, how much is safe harbor? If employee cost as a percentage of operating expense, that means you need to see how much percentage is employee cost. If employee cost is less than 40%, minimum 18% operating profit margin you should show. If employee cost is more than 40% but less than 60%, minimum 21% operating profit margin you should show. If employee cost is more than 60%, then minimum 24% you should show operating profit margin. Are you able to understand? If you disclose a minimum that operating profit margin, then whatever your actual transaction is there, that will be deemed as arm's length price. Are you able to understand? Next, intra-group loan. That means from your associated enterprises, you have taken loan and you have taken loan in Indian rupees. Okay. So, loan to non-resident associated enterprise, not by NBFC. See, NBFC main business is giving loans. If NBFC itself is giving loan, this provision is not applicable. Other than NBFC, if any other person gives loan to its associated enterprise who is non-resident, then minimum acceptable interest rate. If credit rating of your associated enterprise is between AAA to A, then marginal cost of lending rate as on 1st April of previous year plus 1.75%. Minimum that percent interest you should charge. Then only like your transaction will be deemed as arm's length price. If your credit rating is BBB minus, BBB or BBB plus, marginal cost of lending rate as on 1st April of previous year plus 3.25%. Minimum that much interest rate you should charge. Let's say like A Limited, incorporated in India, giving loan to its associated enterprise located in Singapore. Okay. Now, loan given 1 crore rupees. Interest rate. Minimum, let's say SBI interest rate is 8%. 8 plus 3.25%. 11.25%. Minimum 11.25% interest should be charged. If 11.25% interest is charged, whatever the transaction that you have done, it will be deemed as arm's length price. Are you able to understand? If credit rating is between BB to B, then additional spread is 4.75%. If credit rating is between C to D, additional spread is 6.25% you need to add. If there is no credit rating and total INR loans to all associated enterprises is less than or equal to 100 crore, then you need to add additional spread of 4.25%. Okay. Next, if intra-group loan is less than or equal to 250 crores and is denominated in foreign currency, then minimum acceptable interest rate is reference rate for that foreign currency as on 30th September plus additional spread. How much is additional spread? Credit rating AAA to A minus, additional spread 1.5%. Credit rating BBB minus, BBB plus, additional spread plus 3%. If there is any lower rating, additional spread 4%. Minimum that much interest rate you should charge. If you charge that much interest rate, whatever your actual transaction is there, that will be deemed as arm's length price. Next, if intra-group loan is more than 250 crores and is denominated in foreign currency, minimum acceptable interest rate, reference rate for that foreign currency as on 30th September plus additional spread, AAA to A minus 1.5%, triple B minus triple B plus 3%, BB plus to BB minus 4.5%, any other no rating 6%. Okay, corporate guarantee. To whom you have given corporate guarantee? You gave explicit corporate guarantee to wholly owned subsidiary being a non-resident. For wholly owned subsidiary, if you give corporate guarantee, generally if corporate guarantee is given, fees will be charged. How much minimum fees you should charge? Minimum you should charge 1% per annum. Commission or fees must be greater than or equal to 1% per annum of guaranteed amount. If your fees is 1%, 2%, 3%, then whatever your transaction is there, it will be deemed as arm's length price. But your fees is less than 1%, then it will not be deemed as arm's length price. Safe harbor provisions will not apply. Income tax officer will calculate the, assessing officer will calculate the arm's length price. Next, if you do R&D services relating to software development, and if value of international transactions are less than or equal to 300 crores, then minimum operating profit margin should be greater than or equal to 24%. That means like you are not providing software services, you are providing research and development services with regard to software development. And how much is value of international transaction? Value of international transaction is less than or equal to 300 crores. Then in your books, in your P&L account, minimum you should show operating margin 24%. Then whatever your actual transaction is there, that will be deemed as arm's length price. Okay. Next, if you are providing research and development services relating to generic pharma, pharmaceutical business, right? You are not providing pharmaceutical services for, you are providing research and development in relation to pharmaceutical business. Then minimum value of international transaction should be less than or equal to 300 crores and minimum operating profit margin should be more than 24% or equal to 24%. Then whatever your actual transaction is there, that will be deemed as arm's length price. Next, if you are manufacturing and exporting core auto components and original equipment manufacture sales should be greater than or equal to 90% of total turnover, then minimum you should disclose 12% margin. If you disclose minimum 12% margin, then whatever actual transaction is there, that will be deemed as arm's length price. Manufacturing and exporting non-core auto components. If you are exporting non-core auto components, minimum 8.5% operating margin you should disclose. Then only transaction price will be deemed as arm's length price. For some specified domestic transactions also, safe harbor rules are there. If you are in the business of transmission of electricity, then Electricity Act will specify some rates. If you supply minimum at that rates, then whatever your transaction is there, that will be deemed as arm's length price. Are you able to understand? Next, purchase of milk or milk products. Cooperative society will release the rates. If you minimum sell at that rates, then whatever the actual transaction is there, that will be deemed as arm's length price. Very simple. Government Income Tax Act, lawmakers of Income Tax Act, they are keeping some margins. If you disclose your transaction, if you minimum disclose that margin, whatever transaction that you are doing, that transaction itself will be deemed as arm's length price. Are you able to understand? Good. That is available. You can download this PDF, okay, and start solving the problems. All past exam questions, model question papers are completely covered in this question bank. If you solve this question bank, it will give you confidence. Definitely one question will come in the examination from DTAA. If God's grace is there, you will get 2 questions from DTAA. So don't take DTAA lightly. Very important chapter from examination point of view. So shall we start the concept quickly? See, what do you mean by double taxation? First of all, if one income is taxable in 2 or one or more countries. For example, let's say Virat Kohli is there. He went to Australia. He played in Australia. He won Man of the Match award. On Man of the Match award, he is required to pay tax in Australia. He is also required to pay tax in India. That means what? On same income, if two countries levy tax, that concept we call as double taxation. Are you able to understand? So, like on same income, two or more countries are levying tax. That concept we call as double taxation. Sir, why double taxation arises? The reason is any country in the world will levy tax based on two rules, either based on resident rule or based on source rule. Resident rule means what? Once a person is resident in one country, that country will get right to levy tax on global income of a person. Virat Kohli is resident in India. Once Virat Kohli is resident in India, India will get right to levy tax on Virat Kohli not only on Indian income but on global income. Are you able to understand that concept of levy of tax we call as residence rule? Are you able to understand? That means what? Residence rule means like the country in which a person is resident, okay, then that country will get right over that resident to levy tax not only on that country's income but on entire global income. That rule we call as residence rule. Now what India will do, as Virat Kohli is resident in India, Virat Kohli is required to pay tax in India not only on Indian income but on global income. That concept of levy of tax we call as residence rule. Are you able to understand? Source rule. What do you mean by source rule? Even though a person is not resident in India, but if a person uses country's resources and earns income, then in that case, tax is levied by source country. Virat Kohli went to Australia. He did not play in India. He played in Australia and he earned income in Australia. That means by playing in Australia, Virat Kohli earned income. Such income is taxable to Virat Kohli in Australia also. Australia will levy tax not based on resident rule. Virat Kohli is not resident in Australia, but Australia will levy tax based on source rule. Virat Kohli is getting man of the match income. Man of the match award, $10,000. That $10,000 came from Australia. So as $10,000 are earned in Australia, source of $10,000 is in Australia, Australian government will levy tax. That type of rule we call as source rule. Are you able to understand? So any country in the world will levy tax based on two rules. Residence rule, source rule. Residence rule means what? Once if a person is resident in one country, then country will get right not only tax that country's income but on global income. Next, source rule means what? Even though a person is not resident, like David Warner is there, he came to India, he played in IPL. David Warner is not resident in India, but David Warner earned income in India. By playing in India, he earned income. On that income, India will get right to levy tax. That basis of levy of tax we call as source rule. Are you able to understand? So any country in the world will levy tax based on two rules, either based on residence basis or on source of income basis. That is the concept. Now what will happen? One country will levy tax based on resident rule, another country will levy tax based on source rule. That's why it is leading to double taxation. Double taxation is not good to the economy. Double taxation is harmful to the economy. See, Virat Kohli earned $10,000. On $10,000, Australian government took $3,000. Indian government took $3,000. Now Virat Kohli is left with only $4,000. That means like it pinches taxpayer. Taxpayer, if he pays tax in both the countries, it will be very heavy to the taxpayer. That's why to avoid concept of double taxation, internationally double taxation avoidance agreements will be entered into. Are you able to understand? To counter the concept of double taxation, internationally relief will be given. Relief will be given to double taxation. That relief is classified into how many types? That relief is classified into two types. Relief through DTAA, unilateral relief. DTAA means what? For example, there are two countries, India and Australia. In between India and Australia, there is DTAA, Double Taxation Avoidance Agreement. then based on the double taxation avoidance agreement, relief will be given. Either India will levy tax or Australia will levy tax, or both will not levy tax. Then in that way, they enter into double taxation avoidance agreements. Sometimes with certain countries, there will be no DTAA. In that case, like India itself will give the relief. Such relief we call as unilateral relief. Are you able to understand? First of all, double taxation is not good to the economy. To counter double taxation, relief will be provided. And that relief is classified into how many types? That relief is classified into two types: bilateral relief, unilateral relief. Bilateral relief means what? Both the countries will have DTAA. Based on that DTAA, relief will be given. That relief we call as bilateral relief. Like for example, ministers of India, ministers of Australia, they both will sit across the table and they will like negotiate and they will write the DTAA. As per the DTAA, like benefit will be given, relief will be given. Either India will levy tax or Australia will levy tax. That type of relief we call as bilateral relief. Unilateral relief means there will be no DTAA. Let's say like I am doing transactions in India and I am also doing transactions in Cyprus. That means I am having transactions in both the countries, India and Cyprus. But India and Cyprus do not have DTAA. If they do not have DTAA, in that case, whatever the tax I paid in Cyprus is there, from that tax relief will be given by India only. Such type of relief we call as unilateral relief. Are you able to understand? So, bilateral relief will be discussed in section 90 or 90A. Unilateral relief will be discussed in section 91. Now, first I will explain bilateral relief, then I will explain unilateral relief. Okay. Bilateral relief. This bilateral relief is classified into two types: tax exemption method tax credit method. Sir, what do you mean by tax exemption method? In case of tax exemption method, source country will levy tax and resident country will not levy tax. In resident country, such income is exempt. Are you able to understand? So, there will be two countries: resident country, source country. Now, resident country, no tax, and source country levies tax. That concept we call as tax exemption method. That means whatever the income earned in source country is there, on that income, source country will only levy tax, resident country will not levy tax. In resident country, such income is exempt. Let's say India, Australia have DTAA. In the DTAA, they have written tax exemption method. Tax exemption method means what? In this case, whatever the man of the match won by Virat Kohli is there, on that man of the match, Australia will levy tax. India will not levy tax. In India, whatever the man of the match award income is there, that is fully exempt. So tax exemption means what? Tax exemption method means source country will have right to levy tax, and whatever the tax that is levied in source country is there, that amount, that income is not taxable in the resident country. That concept we call as tax exemption method. Are you able to understand? Next, tax credit method. What do you mean by tax credit method? There will be resident country and there will also be source country. Now, let's say source country is whatever the tax paid in source country is there, that will be allowed as credit in resident country. That concept we call as tax credit method. For example, on man of the match award, $10,000. Tax is $3,000. Let's say in India tax is $8,000. But already $3,000 tax is paid in Australia, right? That $3,000 will be allowed as credit in India. Are you able to understand? Tax exemption method means only one country will levy tax, another country, in another country that income is exempt. Tax credit means what? Like both countries will levy tax, but whatever the tax paid in source country is there, that is allowed as credit in the resident country. Are you able to understand? So tax exemption method, tax credit method. Tax exemption method means like if you earn on foreign income, foreign country will levy tax. Resident country will not levy tax. That concept we call as tax exemption method. Tax credit method means what? Like foreign income, foreign country will levy tax. Resident country will also levy tax, but whatever the tax paid in foreign country is there, that is allowed as credit from tax payable in resident country. Such method we call as tax credit method. So double taxation harmful to the economy. To avoid double taxation, relief is provided. That relief is classified into two types: bilateral relief, unilateral relief. Bilateral relief means two countries with understanding they will give the relief. So when two countries come together and they have an understanding, memorandum of understanding, that we call as double taxation avoidance agreement. Through DTAA, bilateral relief will be provided, and that bilateral relief will be provided either under tax exemption method or tax credit method. In case of tax exemption method, if income is taxable in foreign country, source country, it is not taxable in resident country. Under tax credit method, if whatever the tax paid in foreign country is there, such tax is allowed as deduction, allowed as credit from tax payable in resident country. That method we call as tax credit method. Tax exemption method first we will discuss, then I will discuss with you tax credit method. Now, tax exemption method. First of all, full exemption method. Full exemption method means what? Whatever the foreign income is there, on foreign income, completely tax will be levied by foreign country, source country. Resident country will not levy tax. Are you able to understand? In resident country, foreign income is fully exempt. Such method we call as full exemption method. You can see here, Mr. Prabhas, resident individual, has earned following incomes for 24-25. Income from house property in India but received in UK. This is Indian income, 7 lakh rupees. Royalty on patents outside India. This is foreign income. Past untaxed income brought to India, that is not taxable. Tax paid in respect of A, B and C above are 90,000, 75,000 and 20,000 respectively. Calculate tax liability and relief as per tax exemption method. See, you can see in case of full exemption method, only Indian income is taxable, foreign income is not taxable in India. Okay, on foreign income, only foreign country will levy tax. Foreign income is fully exempt in India. Such type of method we call as full exemption method. Here he is having two incomes, Indian income 7 lakhs, foreign income 5 lakhs. But foreign income is not taxable in India. Only Indian income 7 lakh rupees is taxable in India. Foreign income is fully exempt. Next, second method, exemption with progression method. You can see tax exemption will be given in two ways: full exemption method, exemption with tax progression method. What do you mean by exemption with progression method? Under this method, like foreign income will be considered in calculation of tax rate in India. You can see income from state of source is considered by state of residence only for the tax rate purpose. Sir, we did not understand. That's why I am there here with you. I will tell one example. You will get complete clarity. An Indian company has earned income from Indian sources 75 lakhs, income from foreign sources 35 lakhs. See, there is Indian company. Indian income, how much? 75 lakhs. Foreign income, 35 lakhs. So total 110 lakhs. See, in case of full exemption method, only Indian income is taxable, foreign income is not taxable. In case of exemption with progression method, Then also Indian income is taxable, foreign income is not taxable. But the difference is we will calculate tax on total income. Okay, then after calculating tax on total income, whatever the foreign income is there, on foreign income, relief will be provided. That means initially under exemption with progression method, you need to calculate tax on total income. Once you calculate tax on total income, then you have to give the relief. Okay. See, this tax exemption method, tax credit method, all these are not there in CA final also. These concepts are exclusively given in CMA final. So these are exclusive CMA final concepts. So listen very carefully. Understand how depth in CMA Institute is preparing materials. These concepts are not there in CA final also, but are there in CMA final material. Okay. Now, tax on total income. How much? Listen till the end, you will understand. How much is tax? 110 lakhs into 30%. For domestic company, tax rate is 30%. 33 lakhs. To this we will add surcharge. Because if total income is more than 1 crore, in case of company, surcharge is applicable. 7%. Surcharge at the rate of 7%. How much? 33 lakhs into 7%. 2,31,000. So 33 lakh plus 2,31,000, 35 lakh 31,000. To this we need to add HEC at the rate of 4%. 1,41,240. So how much is tax liability? 35 lakh 31,000 plus 36 lakh 72,240. That is tax. Correct? Now, see, as per tax exemption method, foreign income should not be taxable in India. Under full exemption method, foreign income is fully exempt. Under exemption with progression method also, foreign income is exempt. But we will calculate average tax rate. Based on that, we are going to provide the relief. Less relief under section 90. First, we need to calculate average tax rate. How much is average tax rate? Tax divided by total income into 100. How much is tax? 36 lakh 72,240 divided by 110 lakhs into 100. How much? .384%. That means here relief. Here how much is doubly taxed income? Doubly taxed income is 35 lakhs. On 35 lakhs, you are paying tax in foreign country. You are also required to pay tax in India. But there is DTAA between two countries. The DTAA says exemption shall be given, and the method is exemption with progression method. So foreign income is not taxable in India. As foreign income is not taxable, we need to give relief. How much is the relief? Doubly taxed income is 35 lakhs. 35 lakhs into 33.384%. How much? 11,68,440. That is the relief will be given. And how much is balance tax liability? Balance tax liability is 25,03,800. Now, did you understand how to calculate under exemption with progression method? See, listen till the end. You will get clarity. Now, let me give small explanation. If you follow full exemption method, total income is taxable, foreign income is exempt. That means under full exemption method, you will pay tax on 75 lakhs only. Will you pay any surcharge? No surcharge. But if you follow exemption with progression method, first we need to calculate tax on 110 lakhs, right? Whenever you calculate tax on 110 lakhs, tax was levied, along with tax, surcharge was also levied. Are you able to understand? That means what? Under exemption with progression method, first we will calculate tax on total income. Whatever the average tax rate is there, then average tax rate multiplied with doubly taxed income, we will allow as relief. Are you able to understand? So like in exemption with progression method, calculation is different. Under full exemption method, only Indian income is taxable. Calculate tax only on Indian income. Under exemption with progression method, calculation is different. How to calculate? First you need to calculate tax on total income. After you calculate tax on total income, then by calculating average tax rate, relief will be given on foreign income. Whatever the doubly taxed foreign income is there, that multiplied with average tax rate will be allowed as relief. Are you able to understand? So you can see effectively tax computed is 75 lakhs into 30% into 107% into 104%. Normally, if your total income is 75 lakhs, you are not required to pay surcharge. But if you choose exemption with progression method, see how much is Indian income? Indian income is 75 lakhs. So on 75 lakhs, tax at the rate of 30% was levied. How much it will be? 75 lakhs into 30%, 22 lakh 50,000. And on that surcharge was also levied. How much? 1 lakh 57,500. Next, on that HEC was also levied at the rate of 4%, 96,300. 25 lakh 3,800. Matching, right? Both are. Generally, if your total income is up to 75 lakhs, surcharge should not be levied. But if you follow exemption with progression method, you will consider foreign income in calculating tax liability in India. When you consider foreign income, then your total income is 110 lakhs. So even though 75 lakhs is taxable, additionally surcharge was also levied. Are you able to understand? That means what? When you are calculating exemption with progression method, you will consider foreign income in calculation of tax rate in India. So under exemption with progression method, indirectly surcharge will also be levied on Indian income. Okay. So I hope you got clarity. Exemption with progression method. Next we will discuss tax credit method. Full credit, ordinary credit. What do you mean by full credit? Whatever credit method means what? Tax paid in foreign country allowed as credit in resident country. That method we call as full credit method. Correct? And there is ordinary credit method. In ordinary credit method, resident country allows tax credit which is lower of following: tax paid in source country, proportionate tax of source country income in resident country. This you will not understand theoretically. We will do one problem. You will get clarity. A is resident of country X, went on 3 months assignment to country Y. Salary income of Mr. A is 24 lakhs. Of the above, countrywide taxed 3 months income of 6 lakhs at the rate of 28%. So basically, there is Mr. A. He is resident in country X. In country X, he worked for 9 months and he went to country Y. In country Y, he worked for 3 months. How much is the salary? In country X, salary is 18 lakhs. In country Y, his salary is 6 lakhs. Okay. 18 lakhs and 6 lakhs. What is the tax rate? Countrywide taxed 3 months income of 6 lakhs at the rate of 28%. So tax rate is 28%. What about tax rates in country X? Compute tax liability of Mr. A considering full credit and ordinary credit method under default tax rates. So default tax rates are applicable in country X. So shall we calculate tax liability? So as per tax credit method, both countries will levy tax. Country X will levy tax, country Y also will levy tax. But whatever the tax paid in country Y is there, that is allowed as credit in country X. Are you able to understand? For example, in country X, how much is total income? Total salary is 24 lakhs. 18 lakhs plus 6 lakhs, because salary of country X, salary of country Y, both are taxable in country X, correct? Now, we will calculate tax liability. Under default tax rates, up to 3 lakhs tax is 0. Above 3 lakhs, up to 7 lakh, tax rate is 5%, tax amount is 20,000. Above 7 lakh, up to 10 lakh, tax rate is 10%, tax amount is 30,000. Above 10 lakh, up to 12 lakh, tax rate is 15%, tax amount is 30,000. Above 12 lakh, up to 15 lakh, tax rate is 20%, tax amount is 60,000. Above 15 lakhs, tax rate applicable is 30%. So 24 lakh minus 15 lakh into 30%. How much it will be? 2,70,000. So how much is tax? Tax is 4,10,000. To this we need to add HEC at the rate of 4%. 16,400. 4,26,400. This is tax liability. This is tax on total income, right? Both Indian income and foreign income. 4,26,400. Now, if you follow full credit method, whatever the tax paid in country Y is there, total tax is allowed as relief. Okay. So, how much is tax liability? 4,26,400. From this, you will reduce relief. If you follow full credit method, how much is the relief? Relief will be tax paid in country Y. How much is tax paid in country Y? In country Y, how much is taxable? 6 lakhs. 6 lakh into 28%, how much? 1,68,000. 1,68,000 is relief. How much is taxable? 2,58,400 is taxable. Okay. Next, if you follow ordinary credit method, tax liability is 4,26,400. From this, we will allow relief. We will allow, and that relief is allowed proportionately. Proportionate. How that relief will be calculated? That relief will be calculated in 2 steps. Step 1, tax paid in foreign country. Tax paid in foreign country is 1,68,000. Step 2, tax in resident country into total income of source country divided by total income of resident country. That's the formula. Proportionately relief is allowed. Tax paid in resident country. How much is tax in resident country? 4,26,400. How much income is taxable in source country? In country Y, only 6 lakhs is taxable. Divided by taxable income of resident country. In resident country, total income is taxable, na? 24 lakhs is taxable. So, 6 lakh by 24 lakhs. How much? 426,400 into 6 by 24. 1,06,600. So, out of these two, whichever is lower means 1,06,600 is allowed as relief. That means what? whatever the tax that you are paying in foreign country, total tax is not allowed as relief. Proportionate tax is allowed as relief. Are you able to understand? So tax in our country into proportionate income. How much income is taxed in foreign country? 6 lakhs. If 6 lakhs is earned in India, how much tax would have been paid? That much only relief will be allowed. So 6 lakhs into 4,26,400 by 24 lakhs. Only 1,06,600 is allowed as relief. So how much is balance tax liability? Balance tax liability is 426,400 minus 1,06,600. 3,19,800 is balance tax. Did you understand? So simply average tax. Average tax in India or tax paid in foreign country. Whichever is lower will be allowed as relief. See, just think normally. How much is tax in India? 4,26,400. This is tax for total income of 24 lakhs. How much is foreign income? 6 lakhs. If the same foreign income, if you earn in India, how much is tax that you have paid in India? That much proportionate relief is allowed. So 6 lakh into 426,400 divided by 24 lakhs. Only that much only relief will be allowed. I hope you got great clarity. First, tax exemption method. Two methods are there. Full exemption method, exemption with progression method. In full exemption method, foreign income is fully exempt in resident country. Exemption with progression means foreign income we will consider in calculation of tax rate. Second method is tax credit method. Resident country will levy tax, source country will also levy tax, but tax paid in source country is allowed as relief in resident country. That method we call as tax credit method. Under tax credit method, there are two methods. Full credit method, ordinary credit method. Under full credit method, what we will do? Whatever the tax paid in foreign country, entire tax is allowed as relief in resident country. Under ordinary credit, tax paid in foreign country, total tax is not allowed as relief, only proportionate tax is allowed as relief. Are you able to understand? Next, tax sparing method. What do you mean by tax sparing method? You know about SEZ, right? Special economic zones. Normally, if you have your business in special economic zone, deduction is available under section 10AA. For first 5 years, 100% of export profits are eligible for deduction. From 6th year to 10th year, 50% of export profits are eligible for deduction under section 10AA. Let's say you are earning foreign income, but foreign income is not taxed in foreign country. Foreign income is exempt. Foreign income was not taxed because of deduction under section 10AA, because like foreign income is earned in special economic zone. That's why foreign income is not taxable in foreign country. Even though income is not taxable in foreign country, it will be assumed, it will be deemed that you have paid tax in foreign country, and that deemed tax paid will be allowed as credit from resident country. Such method we call as tax sparing method. Theoretically, you will have problem understanding. Let us do one solution, you will get clarity. See, A Limited is a parent company located in country X, has a branch in country Y. So, there are two companies. A Limited, basically it's a parent company. It has a branch. It has a branch in country Y. Now, parent company is located in country X. Branch earns a profit of 10 lakhs. So, how much is profit of branch? Profit of branch is 10 lakhs. Country X taxes residents on global income at the rate of 30%. So, what is tax rate in country X? Tax rate in country X is 30%. Tax rate in country Y is 25%. So, in country Y, tax rate is 25%. However, as a measure to promote economic development, their special economic zones, country Y is not levying tax. See, generally in country Y tax rate is 25%, but on this profit of 10 lakhs, no tax was levied. Because this profit is earned in special economic zone. In country Y there is special economic zone. From that special economic zone, 10 lakh rupees profit was earned. As profit was earned in special economic zone, no tax was levied in country Y. Even though tax is not levied by country Y, still we will assume tax was paid in country Y and deemed tax paid in country Y is allowed as relief in resident country. So in resident country, in country X, tax on 10 lakhs is 10 lakhs into 30%, 3 lakhs, correct? Now, whether any tax is paid in country Y? No. Even though tax is not paid in country Y, actually in country Y, how much tax is required to be paid? 25%. But in country Y, our unit is located in special economic zone. That's why no tax was levied in country Y. Even though country Y is not levying tax, still relief will be allowed. Relief. How much relief will be allowed? It will be deemed that tax is paid in country Y. 10 lakhs into 25%, 2.5 lakhs, and relief will be allowed. Therefore, balance tax liability is only 50,000 rupees. Did you understand here? That means in case of tax sparing method, whatever the tax that is deemed to be paid in foreign country is there, even the deemed tax is also allowed as relief in resident country if DTAA has tax sparing provisions. Are you able to understand? That means simply saying foreign income is not taxable in foreign country. Even the foreign income is not taxable. If it has been taxable, how much tax that would have been paid, that deemed tax is allowed as relief in resident country. Are you able to understand? Next, economic double taxation, juridical double taxation. What do you mean by this? See, economic double taxation means income is the same, but it is taxable in two different countries in the hands of two different persons. Let's say two countries are there, country A, country B. There is an individual, his name is Musk. He invested 80 crores in Tesla Limited in country B. Now, Tesla Limited earned a profit of 90 crores. Let's say tax rate in country B is 30%. Tax at the rate of 30%, 27 crores will be paid. How much is balance? 90 minus 27, 63 crores. Now, 63 crores will be paid to Elon Musk as a dividend. For example, let's say out of 63 crores, 40 crores dividend is paid to Elon Musk. Now, on this 40 crores dividend, like country A will levy tax at the rate of let's say 20%. How much is the tax? Tax is 8 crores. If you observe, income is same only 90 crores. Income earned by company is 90 crores. On 90 crores, tax was paid in country Y at the rate of 30%. After payment of tax, balance profits. How much? 63 crores. On this 63 crores also, when dividend is given, 40 crore rupees to Musk. On that 40 crore rupees, Musk is also required to pay tax. So, if you see, like on 90 crores, tax is paid in country B and tax is also paid in country A, but not by same person, but in the hands of two different persons. On 90 crores, tax is paid by paid in country B by Tesla Limited, and after payment of taxes, whatever the balance profit is there, 63 crores, if that profit is distributed as dividend, on the dividend is also tax is paid in country A by Mr. Musk. Are you able to understand? That means income is same, 90 crores only. On that income, two times tax is levied. One time tax as a company and another time tax as a dividend in the hands of shareholder in two different countries. Then this concept we call as economic double taxation. Income same, taxed twice in hands of two different persons. Are you able to understand? That concept we call as economic double taxation. Next, juridical double taxation. What do you mean by juridical double taxation? We have discussed same income taxed twice in two different countries in the hands of same person. I will tell you economic double taxation, juridical double taxation. In both cases, same income only. Same income. In both cases, taxed twice. But in case of economic double taxation, taxed in hands of two different persons. Very important. Taxed in hands of two different persons. Here, taxed in hands of same person. That is the difference between economic double taxation and juridical double taxation. Best example for economic double taxation is Virat Kohli example. Virat Kohli earned man of the match in Australia. Income is same, man of the match. On man of the match, Australia levied tax, India also levying tax, and both are levying tax on Virat Kohli, same person. That is juridical double taxation. Economic double taxation. Profits of Tesla. On profits of Tesla, Tesla is paying tax in country B, and after payment of taxes, if balance profits are distributed to shareholder Elon Musk, on those profits Elon Musk is also paying tax on dividend. That means overall income is same, okay, but that income is taxed in country A and country B also, but in the hands of two different persons. On business profits, Tesla Limited is paying tax. After payment of tax, balance business profits, if they are given as a dividend, on such dividend, Elon Musk is paying tax. That means income is same only. On that income, two times tax is levied in two different countries in the hands of two different persons. That type of double taxation we call as economic double taxation. I hope you got clarity. We will see one example for underlying tax credit method. A Limited parent company located in country X has a subsidiary company B Limited in country Y. So there are two companies, A Limited, B Limited. A Limited is located in country X, B Limited is located in country Y. B Limited out of its profits 10 lakhs paid dividend to A Limited 1 lakh. So how much is profit of B Limited? 10 lakhs. How much dividend is paid? Dividend to A Limited is 1 lakh. Okay. So A Limited is parent company, B Limited is subsidiary company. Now, other income of A Limited is 11 lakhs. So how much is other income? 11 lakhs. Tax paid. Tax paid in country X is 30%, country Y is 25%. So tax in country X 30%, tax in country Y 25%. Dividend withholding tax rates in country Y is 15%. That means TDS on dividend is 15%. This is the information that is given. Now shall we solve underlying tax credit? First of all, how much is tax paid in country Y? It is how much is profit? 10 lakhs, right? 10 lakhs into 25%. How much is profit? 10 lakhs. How much is tax? 25%. 10 lakh into 25%, tax is 2.5 lakhs. How much is balance? 7.5 lakhs. From the 7.5 lakhs, how much dividend is paid to A Limited? Dividend 1 lakh rupees. How much is other income? Other income is 11 lakhs. So how much is total income? Total income is 12 lakhs. Now on this 12 lakhs, tax is required to be paid in country X, right? Now before payment of this 1 lakh, how much TDS was deducted? TDS at the rate of 15%. 15,000 TDS was deducted and only 85,000 is paid to A Limited, correct? Now how much is tax? Tax on 12 lakhs, tax at the rate of 30%. 12 lakh into 30%, 3,60,000. From this we need to reduce. How much we need to reduce? 3,60,000. How much is tax paid in country Y? 2,50,000. Tax paid in country Y. 2,50,000. And how much is TDS deducted? 15,000. That will also be. How much is balance? 3,60,000 minus 2,50,000. 95,000 is tax liability in country. Very simple. Here Elon Musk is receiving dividend income. Even though he is getting dividend income, from where dividend is paid? Dividend is paid out of business profits. On business profits, already country-wide levied tax of 25%. So whatever the tax paid on business profits is there, that is also allowed as deduction in resident country. This concept, underlying tax credit, is possible only when there is economic double taxation. That means even though tax is paid on business profits, such tax is allowed as deduction from tax payable on dividend income. Such concept we call as underlying tax credit. I hope you got clarity. Till now we discussed bilateral relief. Now we will discuss unilateral relief. Unilateral relief means what? India do not have DTAA with another country. In that case, India will only give relief from double taxation. Such relief we call as unilateral relief. Unilateral relief is covered under section 91. Unilateral relief is possible only if 4 conditions are satisfied. Condition 1, person should be resident in India. Condition 2, such person shall have foreign income. Condition 3, India should not have DTAA with such foreign country. In that case, this is condition 4. Condition 3 is tax should be paid in foreign country. If all these 4 conditions are satisfied, what is the conjunction? Conjunction is and. If all the 4 conditions are satisfied, then only relief is available, otherwise relief is not available. So to claim relief under section 91, 4 conditions are required to be satisfied. Person should be resident in India, he should have foreign income, and in foreign he should have paid taxes. If you do not pay taxes in foreign country, then there is no concept of double taxation. When double taxation arises, when he pays tax in foreign country and he also pays tax in India, then only concept of double taxation arises. That's why condition 3, he should have paid taxes in foreign country. Condition 4, India do not have DTAA with that foreign country. In that case, relief will be allowed under section 91. Okay. And how that relief will be calculated? That relief will be calculated in certain steps. Step 1, you can see, if there is no DTAA, section 91, then relief will be calculated in following steps. Step 1, compute tax on total income. Okay. Find net total income, Indian income and foreign income. Find out gross tax, find tax on total income. Then calculate average tax rate, gross tax divided by net total income into 100. Step 4, find out tax paid in foreign country. Now, step 5 is lower of step 3 and step 4. Step 6 is relief. You will not understand like this. Let us do one problem. You are going to get clarity. Let's say there is an individual, his name is Uma. He is having Indian income 12 lakhs, foreign income 6 lakhs. So how much is total income? Total income is 18 lakhs. Correct? Now, let's say on 26 lakhs, he paid tax at the rate of 25%. This foreign income is from country Cyprus. With Cyprus, India have no DTAA. If there is no DTAA, then relief will be calculated under section 91. Yeah, one doubt was asked here. In condition 3, tax should be paid in foreign country. It should be really paid. In tax sparing method, we have discussed deemed tax paid in foreign country, that is also allowed as relief in resident country. That concept is not applicable here. That concept is applicable only if there is a DTAA. If there is no DTAA, then relief will be allowed only if you actually pay tax in foreign country. Only if actual tax is paid in foreign country, then only relief is allowed. If actually tax is not paid, then if deemed tax is not allowed as relief, only real tax paid is allowed as relief. I hope you understood, Ganesh. Now, shall we calculate tax? Let's say tax is required to be calculated under default tax rate. Let us calculate. Up to 3 lakhs, tax is 0. Correct? Above 3 lakhs, up to 7 lakh, tax rate is 5%, tax amount is 20,000. Above 7 lakh, up to 10 lakh, tax rate is 10%, tax amount is 30,000. Above 10 lakh, up to 12 lakh, tax rate is 15%, tax amount is 30,000. Above 12 lakh, up to 15 lakh, tax rate is 20%, tax amount is 60,000. Above 15 lakh, tax rate applicable is 30%, so 90,000, correct? 18 lakhs minus 15 lakh into 30%, 3 lakh into 30%, 90,000. So 90,000 plus 60,000 plus 60,000 plus 20,000. 2 lakh 30,000 tax. To this we need to add HEC at the rate of 4%. 9,200. So tax liability is 2,39,200. But on 6 lakh rupees, tax is paid in Cyprus, tax is paid in foreign country. Now, 6 lakhs is getting taxed in Cyprus, 6 lakhs is also getting taxed in India. It is leading to double taxation, right? But whether India is having DTAA with Cyprus, India is not having DTAA with Cyprus. In this case, relief will be allowed under which section? In this case, relief will be allowed under section 91. Relief under section 91 is available. and that relief under section 91 will be calculated. How it will be calculated? First, we need to calculate average tax rate in India. Average tax rate in. What's the formula? Tax divided by total income into 100. How much is tax? Tax is 239,200 divided by how much is total income? 18 lakhs, correct? 239,200 divided by 18 lakhs into 100. How much is the percent? 13.288%. Next, tax rate in foreign country. How much? 25%. Out of these two, whichever is lower, you have to take. Lower is 13.288%. Now, how much is relief? Relief is equal to doubly taxed income into lower tax rate. How much is doubly taxed income? Doubly taxed income is 6 lakhs only doubly taxed, right? So, 6 lakhs into how much is lower tax rate? 13.288%. 79,728 is the. So relief is 79,728. How much is balance tax? 159,472. That is the balance tax. Now did you get clarity, everybody? I hope now you got clarity. If there is no DTAA, first calculate tax on total income. Then allow the relief. How that relief will be calculated? Average tax rate in India, average tax rate in foreign country, whichever is lower. Relief is equal to, what is the formula? Doubly taxed income into lower tax rate. Here doubly taxed income is 6 lakhs. 6 lakhs into lower tax rate 13.288%, 79,728 will be treated as. I hope now you got clarity about relief under section 91. Very, very important. In every alternative attempt, question is asked from relief under section 91. Okay, that much important it is. Very, very important. Relief under section 91 calculate. Now, shall I explain further examples? Remember, always relief you should calculate only on doubly taxed income. On doubly taxed income only relief is available. That income should be taxable in India. That income also should be taxable in foreign country. Whatever the doubly taxed income is there, only on doubly taxed income relief is available. Second example, let's say Indian income is 10 lakhs, foreign income is 6 lakhs. Out of 6 lakhs, 4 lakhs is from USA, 2 lakhs is from Spain. In this case, what we will do? We will calculate relief separately. Okay, we have to calculate relief under section 99 for USA, and we will calculate relief under section 91 for Spain. While calculating relief under section 91, what we will take? We will take doubly taxed income into average tax rate in India or average tax rate in USA. Whichever is lower we will take. Here we will take average tax in India or average tax in Spain, whichever is lower. Okay. Average tax in India or average tax in Spain, whichever. So very simple. In foreign income, if there is income from multiple countries, for each country's income, calculate relief under section 91 separately. I will tell another example. Let's say Indian income 10 lakhs. There is foreign income. This foreign income is royalty. How much? 80 lakhs. Sorry, 8 lakhs. Total income is 18 lakhs. But you can claim deduction under section 80 QQB. Deduction under section 80 QQB is, let's say, 3 lakh rupees. Now, taxable income is only 15 lakhs. Tell me one thing, here foreign income is 8 lakhs, but whether 8 lakhs is doubly taxed income? 8 lakhs is not doubly taxed income. In foreign, 8 lakhs is taxable. But in India, whether 8 lakhs is taxable? No. In India, 8 lakhs minus deduction under section 80 QQB, only 5 lakhs is taxable. So how much is common amount here? Common amount 5 lakh rupees. So in this case, only 5 lakhs is doubly taxed income. Are you able to understand? That means only on this 5 lakhs relief under section 91 is available. Are you clear? So ultimately, the important point is you have to consider doubly taxed income. Whatever the doubly taxed income is there, only doubly taxed income is eligible for relief under section 91. Doubly taxed income into relief under like lower tax rate you have to consider. I can tell another example. Income from house property 6 lakhs. From foreign house property, for example, there is loss from another house property. House property 2 lakhs. In that case, only 4 lakhs is doubly taxed income. On 4 lakhs only relief will be calculated. I hope you are getting clarity. So relief under section 91, always you need to calculate on doubly taxed income. Now let us do some past exam problems so that you will get confidence. Open the QB. This is June 25 exam question and December 24 exam question. We will do exam questions. Remaining you do on your own. If you get any doubt, you can ask me in Telegram chat. Okay. Hari, aged 42 years, a resident individual, furnishes following particulars of income earned by him in India and country SA for financial year 25-26. India does not have DTAA. See, if India do not have DTAA, double taxation avoidance agreement, then relief will be allowed under which section? Relief will be allowed under section 91, correct? So income from profession carried on in India, 10,50,000. Agricultural income from country SA. See, foreign agricultural income is not exempt. Indian agricultural income is only exempt. Foreign agricultural income is taxable under income from other sources. Next, dividend from a company incorporated in country SA, 66,000. Royalty income, 10,10,000. Expenses incurred for earning royalty income, 2,10,000. That means how much is net royalty income? 10,10,000 minus 2,10,000, 8 lakhs. Business loss in country SA, 2,50,000. Assume that royalty earned outside India is eligible for deduction under section 80 QQB. Income tax law of country SA permits set off of business loss against any other income. The rate of income tax in country SA is 15%. So tax rate in country SA is 15%. First of all, we need to write all the incomes. Shall we write all the incomes? Yeah. So how much is income from profession in India? First you need to calculate total income. You need to calculate tax on total income. Then only relief is available for doubly taxed income. Okay. So profession in India, how much is the income? 10,50,000. Next, agricultural income, dividend, royalty, business loss. Business loss is eligible for set off. Assume same loss is like you once you are resident in India, global income is taxable. So if you have loss from another country, as per Indian income tax law, loss from business is eligible for set off. So we can do set off less loss from business. 2,50,000. How much is balance? 8 lakhs, correct? This is PGBP income. To PGBP income, we need to add income from other sources. Agricultural income, 2,65,000. Dividend income, 66,000. Royalty. Royalty is 8 lakhs, correct? So how much is total income from other sources? 8,66,000 plus 2,65,000, 11,31,000. So gross total income 18,31,000. From this, deduction is available under section 80 QQB. How much? 3 lakhs. How much is total income? 15,31,000. Somewhere we did mistake it. I'm sorry. 11,31,000 plus 8 lakhs, it is 19,31,000. So total income is 16,31,000. First, we need to calculate tax on 16,31,000. Whether anything was said, default tax rates or optional tax rates. Opted out of default tax regime. Opted out of default tax regime means paying taxes under optional tax rates. Under optional tax rates up to 2,50,000 tax is zero. Correct? Nil. Above 2.5 lakhs up to 5 lakh tax rate is 5%, tax amount is 12,500. Above 5 lakh up to 10 lakh tax rate is 20%, tax amount is 1 lakh. Above 10 lakh tax rate applicable is 30%. 16 lakh 31,000 minus 10 lakhs into 30%. How much? 1,89,300. How much is tax? 3,01,800. To this we need to add HEC at the rate of 12,072. How much is final tax liability? 3,13,870. From this, relief will be allowed under section 91. That relief will be calculated in. For that relief, we need to prepare working note. Working note, relief under section 91. First, we need to calculate average tax rate in India. What's the formula? Tax divided by total income into 100. How much is tax? 3,13,872 divided by total income 16,31,000 into 100. How much is the tax rate? 19.244%. B. Average tax rate in foreign country. How much? 25%, right? Sorry, 15%. Whichever is lower means 15%. So how much is doubly taxed income? Are we correct? Yeah, 19.24% or 15%. Whichever is lower means 15%. Now, carefully observe how much is doubly taxed income. Profession in India, loss from business in country SA. That means this is foreign. Agricultural income also foreign. Royalty income also foreign. From that you have claimed deduction. Correct? Dividend is also from country SA. That means dividend is also foreign. So add all foreign. 2,65,000 plus 66,000 plus 8 lakh. From 8 lakh deduction is available, right? 8 lakh minus 3 lakh, 5 lakh and 2,50,000 minus. So 2,65,000 plus 66,000 plus 5 lakh minus 2,50,000 loss. So doubly taxed income is only 5,81,000. Doubly taxed income into lower rate. Doubly taxed income is 5,81,000 into 15%. How much? 87,150. How much is tax liability? 2,26,720. So very simple. Recent June 2025 exam question we have solved now. Very easy. I told you section 91 very important. If there is no DTAA, then also relief is available under section 91. On that only question was asked in June 25 exam. Next, shall we solve question number 2? This was asked in December 24 exam. Everybody. Rahul, resident individual and a cricketer aged 30 years, derived income of 15,25,000 from matches played in country X. Income in country X was taxed at the rate of 10% with no basic exemption limit. There is no DTAA. See, June 26, question was asked if there is no DTAA. December 25, question was asked if there is no DTAA. Important. His income from matches in India amounted to 4,90,000. He deposited 1,50,000 in Public Provident Fund, paid LIC premium of 35,000. He deposited 50,000 in National Pension Scheme. This is eligible for deduction under 80 CCD 2. He paid 30,000 towards health insurance premium and 38,000 towards health insurance premium of his parents who are non-residents. See, if parents are non-residents, then maximum deduction allowed is only 25,000. Compute total income and tax liability of Rahul for assessment year 25-26. You can see Indian income 4,90,000. Foreign income 15,25,000. Gross total income. Deductions. See, you know, right, under section 80C, maximum deduction allowed is only 1,50,000. So 1,85,000 is there. Even though it is 1,85,000, it is restricted to only 1,50,000. Deduction for NPS. Deduction for NPS is 50,000. So overall deduction is 2 lakhs. And he paid a health insurance premium, right? For self, spouse and children. If they are normal citizens, maximum deduction allowed is 25,000. If any one of them are resident senior citizen, then up to 50,000 deduction is available under section 80D. Here they are normal citizens only. Aged 30 years means normal citizen only. He is not senior citizen. So only 25,000 is allowed as deduction. Even though he paid 30,000, 30,000 is not eligible. Only 25,000 is eligible. He shall also be entitled for deduction of health insurance premium. See, they are non-residents, so maximum deduction allowed is 25,000. 50,000 deduction is allowed. So how much is total income? 17,65,000. Tax on total income HEC 3,55,680. Now you need to calculate average tax rate. 355,680 divided by total income 17,65,000 into 100. How much? 20.1518%. Or tax rate in foreign country already given 10%. Whichever is lower means 10%. So here how much is doubly taxed income? Foreign income 15,25,000. So from 15,25,000 lower rate is 10%. 10% relief was given and balance is the tax. So likewise do all these problems. If you get any doubt, ask me in Telegram chat. Okay. So this is all about DTAA. Thank you. First of all, taxation of NRI, non-resident Indian. That concept is super important for examination. From that concept only he is asking 7-mark question. So first important concept is taxation of NRI. You know NRI, right? NRI means non-resident Indian. So first we will discuss about taxation of NRI, then we will discuss about taxation of NR, non-resident. Okay. Now, who is called as NRI? Non-resident Indian means, first of all, that individual should be an non-resident in India. In addition to that, he should be an Indian citizen or person of Indian origin. Person of Indian origin. So any individual who satisfies these two conditions. Condition 1, he should be non-resident. Condition 2, he should be either Indian citizen or person of Indian origin. So individual satisfying both of these conditions will be treated as NRI, non-resident Indian. Are you able to understand? First condition, Indian citizen. First condition, he should be non-resident in India, and second condition, either he should be Indian citizen or he should be person of Indian origin in India. So any individual who satisfies both of these conditions, conjunction is and, both the conditions are required to be satisfied, then we call such person as NRI, non-resident Indian. For non-resident Indian, some tax benefits are given in income tax. What are those tax benefits that I am going to discuss with you right now? From taxation of NRI, see, non-resident is different, non-resident Indian is different. First of all, understand the difference. Non-resident means he is just non-resident. Non-resident Indian means he is non-resident, along with non-resident he is also Indian citizen or person of Indian origin. So for NRIs, some tax benefits are given. All those tax benefits I am going to discuss with you right now. For example, there is NRI, non-resident Indian. He invested in forex asset. Forex asset means foreign exchange asset. And how that investment was made? Sir, what is called as forex asset? I will tell little later. Non-resident Indian invested money in foreign exchange asset. And how that money is invested? That money is invested in foreign currency. Sundar Pichai is there. He is best example of NRI. Satya Nadella is there, Microsoft. Satya Nadella is Indian citizen. Along with that, he is also NRI in India, non-resident in India. Satya Nadella, more than 180 days, he stays in USA only. So obviously Satya Nadella becomes non-resident in India. Secondly, Satya Nadella is Indian citizen. So we can tell Satya Nadella as NRI. Sundar Pichai is there, Google CEO. He is also NRI. Now, whenever NRI invests money in India, and where that money is invested in foreign exchange asset, what is called as foreign exchange asset, I will tell little later. But how that money is invested? That money is invested not in Indian currency, that money is invested in foreign currency. Okay, now what do you mean by forex asset? Forex asset means investment in shares of an Indian company. Those shares of Indian company, that Indian company can be either private limited company or public limited company. Or forex asset means investment in debentures or deposits of Indian public company or investment in central government securities. So whenever non-resident invests money in India, and how that money is invested in foreign currency. With that foreign currency, what he purchased a foreign exchange asset. What do you mean by foreign exchange asset? Either shares of an Indian company. See, with foreign currency, he can buy shares of private limited company in India or public limited company in India, or he can purchase the debentures. If he is purchasing debentures, very important, he can purchase only debentures of public company. If he purchases debentures or deposits of private limited company, then it will not be treated as foreign exchange asset. Foreign exchange asset means investment should be made in debentures of public limited company, or investment should be made in central government securities. Okay, then from this income will be received, right? From this income will be received. Out of that income, if there is investment income means what? Investment income can be either dividend income or interest income. The dividend income or interest income is taxable at the rate of 20%. Generally, dividend or income is taxable at slab rates. But if individual is NRI and through foreign exchange asset, if he is getting interest income or dividend income, that interest or dividend income is taxable at the rate of 20%. Next, if he is getting long-term capital gain, then before 23rd July 24, it is taxable at the rate of 10%. On or after 23rd July 24, it is taxable at the rate of 12.5%. In case of other income, if any other income is received from those forex asset, then that other income is taxable at normal rates. Okay, my dear students, here there is one point which I contradict with ICMAI Institute. In June 2025 exam, one question was asked from taxation of NRI, non-resident Indian. We will do that problem also little later. In that problem, like ICA has taken exemption of 1,25,000 for long-term capital gain. In Bayer Act, if you read Bayer Act under section 115 BB, sorry, under section 115E, 1,25,000 exemption limit is not there, 1,25,000. But ICMA Institute has taken 1,25,000 exemption, which is wrong, I feel. But we need to follow institute, then only we will get marks. So that's why I am writing exemption of 1,25,000. As per Income Tax Act, if you sell foreign exchange asset, you will get long-term capital gain. On that long-term capital gain, 1,25,000 exemption is not available as per Income Tax Act. But in the Institute June 2025 examination question answer, Institute has claimed 1,25,000 exemption. So for your attempt also, if there is long-term capital gain from foreign exchange asset, you please claim 1,25,000 exemption, because you need to follow the Institute, then only you will get marks. Okay. And investment income is taxable at the rate of 20%, correct? And it is taxable on gross basis. No deduction is allowed. Expenditure is not allowed against that income. Chapter 6A deductions are also not allowed against that income. That means from foreign exchange asset, you got interest income or you got dividend income. From that interest or dividend, don't claim any expenses. Don't claim any chapter 6 deductions. That investment income is completely taxable on gross basis at the rate of 20%. Next, if you get long-term capital gain, generally when you will get long-term capital gain on sale of foreign exchange asset, you will get long-term capital gain. From that long-term capital gain, you cannot claim indexation. Indexation benefit is not available, and chapter 6A deductions are also not available. And in this case, first proviso to section 48 is applicable. What is first proviso to section 48? I will explain little later. That is applicable. By applying first proviso to section 48, you have to calculate long-term capital gain in Indian rupees. And from that long-term capital gain, as per ICMA Institute, you can claim 1,25,000 exemption. Balance it is taxable at the rate of 12.5%. Now, so far, are you clear? Kindly confirm in the chat. This is non-resident taxation. It will be like this. Please have some patience. There is foreign exchange asset. You sold foreign exchange asset. On sale of foreign exchange asset, you are going to get long-term capital gain. Now, if this long-term capital gain is reinvested, within how much time you need to reinvest? Reinvested within 6 months from date of transfer. Within 6 months from date of transfer. Where you should make reinvestment? You should make reinvestment in any other foreign exchange asset. I told foreign exchange asset means shares of Indian company, private limited or public limited, debentures of public limited company, and central government securities. These are called as foreign exchange assets, correct? So you can make reinvestment in any other foreign exchange asset or savings certificates issued under savings certificates issued under section 10(4)(b). If you make reinvestment, then how much ever the amount that you have reinvested in foreign exchange asset or saving certificates, that is eligible for exemption. Sir, how much exemption is available? Total amount is not eligible for exemption. Here exemption is available proportionately. Okay, exemption is equal to long-term capital gain into reinvestment divided by net consideration. What do you mean by this? That means whatever the net consideration is there, out of net consideration, how much amount you reinvest, that much amount is eligible for exemption. So exemption available is proportionately very important 6 months. If reinvestment is made after 6 months, then you cannot claim exemption. Within 6 months from date of transfer, you should make reinvestment, and exemption is also available proportionately. Okay, capital gain, gross capital gain into reinvestment divided by net consideration. Are you clear? In like next, there is lock-in period. Lock-in period is 3 years. You know lock-in period, right? Once you make reinvestment, reinvested foreign exchange asset, you should not transfer within a period of 3 years. If you transfer within a period of 3 years, then reinvested asset is not eligible for exemption. Like whatever the exemption that you have claimed earlier, it will be reversed and taxable as capital gains. First of all, you sold foreign exchange asset, you got capital gain, you made reinvestment. Now you will claim exemption, correct? Within 6 months, if you reinvest in foreign exchange asset, you will claim exemption. After claiming exemption, whatever the reinvested asset is there, you should not transfer reinvested asset for a period of 3 years, lock-in period. If you transfer within a period of 3 years, in case of violation, what is the solution? In case of violation, there is no solution. Earlier exemption that you have claimed, that will be reversed and taxable as capital gains. Okay, so in case of violation, earlier exemption is reversed and taxable as long-term capital gain in the year of violation. Next. So till here, are you clear, everybody? Now, I will tell one small point. Section 115H. In previous year 23-24, you are NRI. In previous year 24-25, you became resident in India. In 24-25, you stayed in India for more than 182 days. The moment you stay for more than 182 days, you automatically becomes resident in India. Now, the question is, sir, earlier he is NRI. In current year, he became resident in India. Now, in earlier year, he calculated income based on NRI provisions. Now, in current year, he became resident in India. The question is whether last year NRI provisions, will they continue to apply in current year as well? The answer is yes. Okay. So, even after he becomes resident in India also, still NRI provisions will apply. NRI provisions will continue to apply if declaration is given by SSE and then investment income is taxable at the rate of 20%. Okay. There is one last section, section 115I. What this section says is, see, taxation of NRI. This is given in chapter 12A of Income Tax Act, chapter 12A. So, whatever the chapter 12A provisions are there, NRI taxation provisions, those are optional. If NRI wants to follow, he can follow chapter 12A, otherwise he can follow regular tax rates that are applicable for non-residents. Okay. So chapter 12A provisions are optional. Provisions are optional. What do you mean by this? NRI, he has two options. Either he can follow normal tax rates or he can follow chapter 12A. Okay. Non-resident Indian, NRI. NRI is not required to file ITR. Non-resident Indian is not required to file ITR. If two conditions are satisfied. Condition 1, if total income includes investment income and long-term capital gain. Condition 2, if TDS is deducted. See, generally before making payment to non-resident, TDS will be deducted. So if NRI has only that long-term capital gain or investment income, and on that income already if TDS is deducted means, then NRI is exempted from filing income tax. Okay. So these are the provisions relating to chapter 12A, very important. Even recent attempt in June 2025 also question was asked from taxation of NRI. Ganesh, you asked me one question I did not understand. Is 115H specific to the lock-in? No, 115H is relating to investment income and long-term capital gain. Earlier he is NRI. When he bought foreign exchange asset, he is NRI. Later on, in subsequent years, he is resident in India. Even though he is resident in subsequent years, in the year of purchase of forex asset, he is NRI, right? So even in subsequent years also, NRI provisions can be applicable and investment income is taxable at the rate of 20%, but only condition is assessee should give declaration to apply same NRI provisions even in subsequent years also. Okay. I hope you got clarity. Now we will solve one problem. Jahir, an Indian citizen resident of Germany, gives the following information to you relating to financial year 24-25. Long-term capital gains 5,67,000 gross on transfer of foreign exchange asset. See, this is the question which was asked in June 2025 exam. Okay, 7 marks. Question number 4B. Every time he is asking from non-resident taxation only. So one question pakka from non-resident taxation. When it was received 12th August 2024. See, generally 5,67,000. It was received after 23rd July 24, right? So ideally it is taxable at the rate of 12.5%. 1,25,000 exemption is not available. You can check section 115E also. But if you see institute calculation, institute has claimed 1,25,000 exemption, and only on balance amount institution like institute calculated tax at the rate of 12.5%. Actually this calculation is not correct. That's why I have mentioned very clearly in the brackets 1,25,000 exemption is not available under section 115E, but institute claimed such exemption. I am helpless. In December 25 attempt also, I suggest you to claim 1,25,000 exemption even though it is wrong, because we need to get marks. If institute is in that notion, we need to accept the institute and we need to go further. Otherwise, what can we do? Now, interest from notified government bonds. See, these are notified government bonds. Notified government bonds, if you make investment in government securities, then also it will be treated as forex asset. So from forex asset, if you get any investment income, that should be taxable at the rate of 20%. So, but surprisingly, institute taxed it at the rate of 10%. I did not understand why institute taxed it at 10%. So I have written disclaimer. Tax on investment income is taxable at the rate of 20%, but institute considered 10%. I do not know. Okay. So these type of things will be there. Non-resident taxation itself is complicated. In addition to that, there are some mistakes in the suggested answers issued by institute. So that's where luck matters. Okay, you are in some notion, in a wrong notion, you took tax rate of 10%. Luckily, your answer is correct. As per provision, it is not. Okay. Next, amount spent on earning interest. I told you, investment income is taxable on gross basis. No deduction is available. Expenses are not allowed. Chapter 6 deductions are not allowed. Next, dividend from shares in Indian companies. So how much is the dividend? 80,000. That is taxable at the rate of 20%. Next, TDS was deducted. See, if TDS is deducted, then ITR is not required to be filed by non-resident Indian. Investment in shares of Indian companies, date of investment. See, tell one thing. When he sold foreign exchange asset, he sold on 12th August 2024. Sold foreign exchange asset on 12th August 24. When he made reinvestment was made on 31st March 2025, correct? Now, whether that reinvestment is before 6 months or after 6 months, that reinvestment is after 6 months. If reinvestment is made after 6 months, is it eligible for exemption? It is not eligible for exemption. I told you very strictly, reinvestment should be made within 6 months from date of transfer. Then only exemption is available. Otherwise, exemption is not available. Here, in this case, you cannot claim exemption. Okay. In question itself, he has said, calculate in accordance with chapter 12A. That means he is asking us to calculate using NRI provisions, non-resident Indian. So you can go through the calculation I have explained. So after taxation of NRI, ICMA institute is testing on presumptive provisions of non-residents. Presumptive provisions of NRIs, non-resident or non-resident. Now, shall we see that presumptive provisions in case of NRIs? Very simple topic, easily you can score in the examination and you can get marks in the exam. Yeah. You can see 44B, presumptive taxation of non-resident shipping business. We have discussed in class, in case of non-resident shipping business, that means what? Let's say foreign ship is there. It is coming to India and it is carrying passengers from India to outside India and outside India to India. So whenever non-resident who is engaged in shipping business, if he do business with India, that means if he operates ships from Indian port to outside port and outside port to Indian port, then that non-resident is taxable in India because he is getting money from India. Now, like, he is not required to maintain books of accounts and all. Whenever whatever the freight collected by non-resident shipping business person is there, out of freight collected, 5% will be deemed as presumptive income. Okay, now whatever the freight collected, freight can be collected either in India or outside India with regard to transportation of passengers from outside port to Indian port or Indian port to outside port. Very simple. In case of non-resident shipping business, how much is presumptive income? You need to remember 5%. 5%. Non-resident shipping business, presumptive income 5%. 5% of what? 5% of freight received. That freight can be received either in India or outside India, and that freight should be received with regard to carriage of passengers or carriage of goods either from Indian port to outside port or outside port to Indian port. 5% will be treated as presumptive income. Okay, so applicable to non-residents engaged in the business of operating ships excluding cruise ships. See, you know cruise ships, right? Yachts will be there. For cruise ships, another section is there. Other than cruise ships, if SSC is engaged in business of operating other ships, then for him presumptive income is 5%. Okay, sorry, presumptive income is 7.5%. I'm very sorry. In case of aircraft, percentage is 5%. In case of shipping business other than cruise ships, the percentage is 7.5%. So write down. We will prepare one chart so that it will be very easy for you to remember. Okay, so non-resident shipping business other than cruise ships. How much is presumptive income? 7.5% of freight. That freight can be either received in India or outside India. Received in India or outside India. Okay. I'm very sorry. And freight charges include demurrage charges, handling charges, any other similar amounts. Simply whatever the amount collected from passengers or whatever the amount collected from the persons to carry goods from India to outside India or outside India to India. Freight collected including demurrage charges and handling charges. Whatever the amount received on that freight, 7.5% will be treated as presumptive income. 44 BB. So this is 44B. Next one is 44BB. Applicable to non-resident engaged in mineral oil services. That means what? Let's say non-resident, he came to India. He is engaged in the business of extraction of mineral oil. You can see prospecting, extraction or production of mineral oils. So non-resident will bring plant and machinery to India. Using that plant and machinery, like he is into the business of prospecting, extraction or production of mineral oils. Now that non-resident is also eligible for presumptive provisions under section 44BB. How much is presumptive income? 10% of aggregate receipts. Aggregate receipts means what? Those receipts can be either received in India or outside India as well. Are you able to understand? So non-resident in mineral oil service business. Mineral oil service business. That means he will bring plant and machinery. He is into the business of prospecting, extraction or production of mineral oils. In that business, whatever the aggregate receipts that he has received, out of those aggregate receipts, like how much 10% will be treated as presumptive income. So presumptive income is equal to 10% of aggregate receipts. Next, 44 BBA, operation of aircrafts by non-residents. That means Lufthansa Airlines is there. It is operating airlines from San Francisco to Mumbai, Mumbai to San Francisco. So for transportation of passengers from San Francisco to Mumbai, Mumbai to San Francisco, it will collect a fare from passengers. Similarly, along with passengers, goods will also be transported in the aircraft. So for transportation of goods, like again, freight will be collected for transportation of goods from Mumbai to San Francisco or San Francisco to Mumbai. So in case non-resident is engaged in the business of operation of aircrafts, out of total freight collected, 5% freight will be treated as presumptive income. That freight can be either received in India or outside India. Okay. So 5% of receipts, 44 BBA. Non-resident in business of operating aircrafts. How much will be treated as presumptive income? 5% of aggregate receipts will be treated as presumptive income. Next, 44 BBB, applicable to foreign companies in power projects. So, see this from this concept, section 44 BBB, one examination question was asked, I think in December 24 or June 24. So, presumptive provisions, you need to remember the right percentage. Sufficient, you can solve and you can get marks in the examination. Okay, applies to foreign companies engaged in civil construction or erection, testing or commissioning of plant or machinery. Simply turnkey power projects. So those non-residents are foreign companies. They are not doing business outside India. They are doing business in India. In which business? Civil construction projects or erection, testing or commissioning of plant and machinery. If they are into this business, in this business, whatever the aggregate receipts that are received are there, 10% of gross receipts will be treated as presumptive income. Okay. So 44 BBB. Now applicable to foreign companies engaged in turnkey power projects. Foreign companies engaged in turnkey power projects. How much will be treated as presumptive income? 10% of aggregate gross receipt. Okay. 44 BBC, very important. Recent amendment was also there in December 25 attempt. See, we already discussed section 44B. Section 44B excludes cruise ships. With regard to cruise ships, there is another section. That section is 44 BBC. You can see 44 BBC special provision for cruise ship business. So those non-residents who are engaged in the business of operating cruise ships, for them how much is presumptive income? 20% of gross receipts will be treated as presumptive income. Other than cruise ships, 7.5% is presumptive income. If they are engaged in the business of cruise ships, because in case of cruise ships, freight amount is higher. The amount of price they charge is higher. Entertainment will be there. That's why profits will also be higher. That's why 20% of gross receipts will be treated as presumptive income. So applies to non-resident SSEs. They must be engaged in the business of operating cruise ships. Satisfy conditions as may be prescribed by government. See, these conditions I have explained in recent amendments video, CMA final DT amendments video. Like that cruise ship must be operated in India or in between India and another country, but it should touch at least 2 ports in India. Next, minimum 200 passengers should be there. That means it should accommodate minimum 200 passengers. Then only if he operates that cruise ship, then only he is eligible to choose 44 BBC. All these conditions I have clearly explained in recent CMA final DT amendments video. So, non-resident engaged in cruise ship business. How much is presumptive income? Presumptive income is 20% of gross receipt. Okay. Next, first proviso to section 48. This is very important. This is also being tested in the examination. In one model question paper, one question was asked from this concept. First proviso to section 48. Very important. Listen clearly. Generally, how do we calculate capital gains? first proviso to. Normally, we will calculate capital gains in Indian rupees. Correct. Full value of consideration, we are going to calculate in Indian rupees. Transfer expenses, net consideration, we will calculate in Indian rupees. Cost of acquisition, cost of improvement also we will calculate in Indian rupees. Capital gain will also be in Indian rupees. But in case non-resident, in case of non-resident or foreign company, if they make investment in shares or debentures, shares or debentures of Indian company, then you have to calculate capital gains differently. Normally, we will calculate capital gains in Indian rupees only. But when you are calculating capital gains for non-residents or foreign companies, when if they sell shares or debentures of Indian company, then first proviso to section 48 is applicable. In that case, you have to calculate full value of consideration in dollars, foreign currency. And transfer expenses. Transfer expenses are also required to be calculated in foreign currency. Net consideration will also come in foreign currency. From net consideration, you will claim cost of acquisition, right? That cost of acquisition also you will claim in foreign currency. Thereby you are going to get capital gains. Capital gains will also in foreign currency. In case of first proviso to section 48, indexation benefit is not available. Okay, that means you can only claim cost of acquisition. You cannot claim indexed cost of acquisition as that is not possible. Next, you will calculate dollars, right? Full value of consideration. How will you calculate? For example, you invested money in Indian currency. That Indian currency is required to be converted into foreign currency because for calculation of capital gains, you need to convert Indian rupees into foreign currency. At what exchange rate you will convert? You will convert at TTBR plus TTSR, buying rate plus selling rate divided by 2, average rate on date of transfer. Even transfer expenses also you will convert at average rate as on the date of transfer. But when you are converting cost of acquisition, you will take average rate. Average rate means buying rate plus selling rate divided by 2 on date of acquisition. Okay. So generally you will calculate capital gains in Indian rupees. But if you are calculating capital gains for non-resident or foreign company, calculation of capital gains should be made in foreign currency. Okay. Full value of consideration you need to convert from Indian rupees to foreign currency. At what exchange rate? Average rate as on the date of transfer. Transfer expenses also you need to convert at average rate as on the date of transfer. Cost of acquisition should be converted at average rate as on the date of acquisition. Upon conversion, you will get capital gains in Indian rupees, right? Sorry, capital gains in dollars, right? This should be converted into Indian rupees. At what exchange rate? At the rate of exchange rate as on the date of exchange rate is telegraphic transfer buying rate as on the date of transfer. Using that exchange rate, you will convert capital gains from foreign currency into Indian rupees. Are you able to understand? See, double process. First, you are converting Indian rupees to dollars, calculating capital gains. You will get capital gains in dollars. Whatever the capital gains in dollars is there, you will again convert it into Indian rupees. So it's game. Okay. You need to, what exchange rates you need to consider. For converting full value of consideration, you will consider average rate as on the date of transfer. For converting transfer expenses also, you will consider average rate as on the date of transfer. However, for conversion of cost of acquisition, you will consider average rate as on the date of acquisition. Finally, you are going to get capital gains, right? That capital gains is in foreign currency. When you convert it into Indian rupees, you will consider average rate as on the date of transfer. Okay. Not average rate, you will consider buying rate as on the date of transfer. Accordingly, you are going to calculate the capital gains in case of non-resident or foreign company who sold shares or debentures of Indian company. One question is also asked with regard to this. We will solve that problem. Yeah, Question number 3. Please open question. Question number 2, it is relating to presumptive income. You can do on your own. Question number 3. Dravid, age 45, is non-resident but an Indian citizen. On 11/4/21, he bought 10,000 equity shares of PQR Limited, a listed company, for $5 per share. See, basically he is non-resident. He is buying shares of Indian company. Whenever he buys shares of an Indian company, automatically, first proviso to section 48 is applicable. So Dravid sold all the shares on 12th June 24 for rupees 770 per share. STT paid. Out of the sale proceeds, Dravid bought 11,550 equity shares of another listed Indian company by name EFG Limited on 13 July 24 for 500 per share. Also, he subscribed REC bonds for 10 lakhs on 15 September 24. Buying and selling rates. See, first of all, non-resident bought shares of Indian company. You need to calculate capital gains. While calculating capital gains, first proviso to section 48 is applicable. So full value of consideration you should calculate in foreign currency. Transfer expenses you should calculate in foreign currency. Cost of acquisition you need to calculate in foreign currency. Capital gain also you need to calculate in foreign currency. Correct? Yes, you need to do complete process. That's how the provision is written. Okay. So you can see how many shares are sold. 10,000 shares are sold. 10,000 shares are sold for how much? 10,000 shares are sold for $5. Well and good. 10,000 shares. They are sold for how much? 770, right? Sold all the shares for 770. 10,000 into 770, how much? 10,000 into 770 is 77 lakhs. Now this 77 lakhs is in Indian rupees. You need to convert it into foreign currency. For full value of consideration, you will consider date of transfer. What is date of transfer? Sold all the shares on 12th June 2024. So 12th June 2024 is date of transfer. Which rate you will consider? You will consider average rate. Average rate means 78 plus 76 divided by 2. Average rate is 77. So 77 lakhs divided by 77 rupees. How many dollars? 1 lakh US dollars. Did you understand? Now, so full value of consideration was calculated. Next there is cost of acquisition. They are purchased for how much price? 10,000 shares were purchased for $5. It is already in foreign currency. Now, they are bought in foreign currency. Well and good. So 10,000 into $5 per share, $50,000. So capital gain is 50,000 US dollars. Correct? Capital gain is $50,000. Now that $50,000 is to be converted at TTBR on date of transfer. How much is TTBR on date of transfer? On date of transfer, TTBR is 76 rupees. So $50,000 into 76 rupees, 38 lakh rupees is the capital gain. Now did you understand first proviso to section 48? Again, reinvestment was done. Reinvestment is allowed as exemption. Okay. I hope now you understood first proviso to section 48. Are you clear? Next we will discuss section 194E, very important. It is being asked in the examinations also. This concept 194E. Whenever non-resident sportsman or non-resident athlete comes to India and earns income from India. Let's say in IPL, all foreign players will come to India. They will earn income in India. whatever the income earned by them is there, on that income 20% tax is applicable. Similarly, not only sportsmen, if any athletes, for example, foreign uh, non-resident entertainers. Now let's say Justin Bieber came to India for Ambani wedding. For that event, he charged some remuneration 20 crores. On the 20 crores, he is required to pay 20% tax in India. Are you able to understand? So whenever non-resident sportsmen, including athletes or non-resident entertainers comes to India, they will earn income in India. What are the natures of income that will be earned in India? They can earn income by way of advertising or by way of participation in any game, excluding card game or any sport, or like foreign players will give interviews in India. For giving interviews also, they will get remuneration. Even that remuneration is also taxable at the rate of 20%. Contribution of articles relating to any game or sports in any newspaper, magazine or journal. So other than card game, non-resident sportsman or non-resident athlete, if he earns income by way of advertisement or by way of participation in any game or sport or by way of contribution to articles or magazines, for these three things, if any amount is received, remuneration is received, on that remuneration, they are required to pay tax at the rate of 20% plus surcharge plus health and education cess. Okay, very important. Only non-resident sportsmen, athletes and entertainers are covered. For example, umpire came. Umpire is non-resident. For non-resident umpire, if he comes as a match referee in India, if he gets any income, for that income, 194E is not applicable. 194E is applicable only for non-resident sportsmen, including athletes and non-resident entertainers. Okay. So with regard to this, there is one question in the question bank shared with you. Open, we will solve. Yeah, open question number 4. Open question 4. Ian Morgan, a foreign national and a cricketer, came to India. You all know Ian Morgan. He is from England. Okay, he is England international cricket player. So he is a member of England cricket team. For the year ended 31st March 25, he received 6 lakhs for participation matches in India. He also received 2 lakhs for advertisement of a brand soap on TV. He contributed articles in journal for which he received 15,000. When he stayed in India, he also won a prize of 10,000 from lotteries. See, this is card games, right? This is taxable at the rate of 30% only. What I said, income from advertisement or participation in any game or giving articles. If this income is received, it is taxable at the rate of 20%. If income from card games is received, 115 BB gets attracted, 30% tax is required to be paid. Compute tax liability of Morgan. Very simple. Whatever the incomes that he has received, all these incomes, these are taxable at the rate of 20%. Income from lottery, that is taxable at the rate of 30%. Okay. So 8,15,000. Total is 8,15,000. On that 20% tax, and on 10,000, 30% tax is applicable. To that, HCC is required to be. Next. Are the income specified above subject to TDS? Yes, obviously. Before any payment is made to non-resident, TDS is required to be deducted. What is the rate of TDS? Rate of TDS is 20% plus applicable surcharge plus HEC. So, whoever non-resident sportsmen are there, non-resident entertainers are there, if they come to India for playing IPL, franchise will make payment to non-resident. Before making payment to non-resident only, franchise will deduct TDS and only balance amount will be paid to player. Are you able to understand? TDS is required to be deducted under section rate of TDS 194E, 20% plus applicable surcharge plus HEC. Next, is he liable to file his return of income for assessment year 25-26? See, if TDS is already deducted, then he is not required to file ITR. Section 115 BBA provides that if total income of non-resident sportsman comprises only income referred to in that section and TDS is deducted. See, here Ian Morgan is having 115 BBA income. Along with that, he is also having income from lottery. If he has income from lottery, then he is not exempted from filing ITR. He is required to file ITR only if he has advertisement income or income from participation in any game or from journals, contribution in any articles or journals. Only if he has these three type of incomes, and before paying these incomes, if TDS is deducted, then he is exempted from filing ITR. Otherwise, he is required to file ITR. Okay. He would be liable to file ITR. Why? Because income from lotteries is also there. What would be tax liability had he been a match referee? If he is a match referee, then obviously 115 BBA is not applicable. 20% tax is not applicable. He is liable to pay tax as per regular provision. Okay, you can see. They are subject to normal rates of tax. You know, right? In case of non-resident individual, if he opts out of default tax rates up to 2,50,000 nil, above 2,50,000 up to 5 lakh, above 5 lakh up to 10 lakh 20%, above 10 lakh 30%. Those normal tax rates are only. Okay. So this is the concept relating to 194E. So whatever the important concepts in non-resident taxation that are from examination point of view, all of them are clearly covered in this revision lecture. Thank you very much. Definitely from these concepts only you will get one question in the examination. Okay, I wish you all the very best. Thank you.